just for your information, it looks like the internet issues have improved a little bit. We think we'll be able to start streaming. Our conference line, though, is still down, and we're unsure why that's connected to the internet issue, because it should be two different things. The only people who were using it were the representatives of Nucor, who were continuing to listen, even though they had said they weren't participating. So I hope we're not prejudicing Nucor in any way by continuing. But I'm not sure what else we can do other than continue, so we'll just go ahead that way. Ms. Nelson, you're still under oath, and I think we'll go to Ms. Schmid for any recross.
No recross, thank you.
Okay, thank you. Mr. Moore?
Just very briefly. Ms. Nelson, I want to talk to you about the graph on page 5 of OCS Cross Exhibit 1.
This is the RRA report.
Yes.
Page 5, okay?
Page 5.
Yep.
I believe that this is the graph that you testified to, that it looked like, by your reading of the graph, there were 100 gas cases in 2021. Do I remember your testimony correctly?
No, there's 100 or more total cases, electric and gas.
More total cases. Can you tell from this graph how many gas cases there were?
I can't tell the exact number, but I'll say, looking at 2021, for example, it looks to me to be about half, so
How about 42?
42, I'll accept that number.
Thank you. I have no further questions.
Sorry, our switches have been mislabeled for decades, but I still don't get used to it. Major Buchanan, you have any recross?
No recross.
Okay, Mr. Russell? Commissioner Clark, do you have any questions for Ms. Nelson?
I have no questions. Thank you.
Thank you.
Commissioner Allen?
I have one question, and I'd see if I can articulate this because I may have forgotten part of it during lunch. When we were summarizing some of the testimony that you had and answering questions, you indicated that you could have upward pressure, I believe, I don't want to put words in your mouth, you could have upward pressure on the rate of return in an increasing interest rate environment or even a decreasing interest rate environment. Is that because there's so many other variables, it's not just a one-to-one relationship?
I agree that's part of it, and you just have to think about what is the reason for the change in interest rates. So when I was talking about the low interest rate environment that we saw in 2020, that was a result of a couple factors. One, the Federal Reserve deliberately pushing down rates. We also had high market volatility, and when that happens, there's a flight to safety. So you get investors moving from equities into treasuries. As they move to treasuries, they bid up the price of treasury bonds, and the yields decline. But because there's that flight to safety, there's that inherent assumption that investors are viewing equity as more risky, so they need more return to stay in equities than they would. So that would be my explanation of that.
That's what I thought you said, and I just want to make sure I understood. Thank you.
You're welcome.
Okay, thank you. I just have one question. I think it was during your cross-examination from Ms. Schmid, when you, if I'm remembering correctly, you referred at a high level to looking at, to your models as a forward-looking evaluation and to looking at other jurisdiction ROE determinations as a historical or backwards-looking. Again, without analyzing each one of those and the reasoning for each of the other cases, should we presume, though, that to some extent at least those other jurisdictions are basing their evaluations and basing their decisions on forward-looking models?
I think that is a good question, and I think that is generally the objective. You know, as we all participate in these proceedings across the country, we're under that same impression that the cost of equity should be set using forward-looking information, and it's a forward-looking exercise. Now, of course, we have historical data that is being used as the inputs, and so my comment was For any given rate case, the evidence in the record is going to be backwards looking and lagged between the time of the proceeding and then the ultimate ROE decision by the commission. So, and it's my experience that I think most commissions do consider both forward-looking and backward-looking data, but recognizing that the ultimate objective should be forward-looking. I hope that answers your question.
Yeah, no, thank you. I appreciate that answer. And thank you for your testimony today.
Okay, thank you very much, Mr. Chair.
Can I raise just one matter, Mr. Chairman?
Certainly.
So we, during the lunch hour, prepared it in response to Commissioner Clark's earlier comment about the uncontested and contested summary. We prepared a revised Exhibit A to replace the one that was attached to the other. And if I could just bring, everybody else has a copy. If I could bring you a copy.
Certainly. You've decided not to concede all those issues on the right.
So that will just, you'll keep the first page, that will just be the Exhibit A for that document. We'd ask that as corrected, be submitted into the record.
Okay, if there's any objection to that motion, please indicate your objection. I'm not seeing one from anyone, so that motion is granted. So for the cost of capital portion of the hearing, since we're kind of splitting this up, or is there anything further from Dominion?
So among the parties, because there are some experts from out of town, rather than to accommodate their flight schedules, the preference was, they've asked us to wait to have Mr. Mendenhall go on, even though he has some cost of capital testimony. And in lieu of that, to let the FEA call their witness now, because he has a flight, I think, at 5 p.m. tonight. And then the office's witness also has a flight, I think, tomorrow, but we want to make sure he gets home. So that was what the parties had discussed, and unless you, and that's of course subject to whatever you want to do. But
Sure, no, that makes sense. Just one mechanical question. Are we intending to split up Mr. Higgins' testimony then, since we're doing cost of capital separate and then going back to other revenue requirement issues? Are we planning to put him on the stand twice, or?
No, Mr. Higgins' testimony does include a placeholder for cost of capital. He's not offering a particular opinion about it. It's mostly just an effort to, he's going to include something for his revenue requirement model, and so he just used some numbers that were out there. He's not offering an affirmative opinion in the same way that these other witnesses have. So we don't intend to put him on for cost of capital specifically.
Okay, thank you. That clarifies that. Okay, then you don't have anything else at this point?
so at this point, we'd wait until Mr. Mendenhall to finish up on all of our cost of capital, and we'd go to the FEA's witness.
Okay, Major Buchanan?
Yes, federal executive agencies call Mr. Walters.
Good afternoon, Mr. Walters. Do you swear to tell the truth? I do. Thank you.
Good afternoon, Mr. Walters. Can you please state your full name for the record?
Christopher C. Walters.
And where are you employed and in what capacity?
I'm employed as an associate at the firm Brubaker & Associates in Chesterfield, Missouri.
And did you provide direct and surrebuttal testimony in this case?
Yes.
And
I think we can all in the room hear you very well, but I'm not sure you're on the microphone for streaming purposes. If the green light's on, you're good.
Is that better?
Yes, thank you.
Apologies.
okay, Mr. Walters, do you have in front of you what have been marked as FEA exhibits 1 through 1.16?
Yes.
And just to clarify, that would be your direct testimony as well as the attached exhibits?
Yes.
And do you also have what has been marked as FEA Exhibit 3.0 and the attached FEA Exhibit 3.01?
Yes,
And is that your sir rebuttal testimony and the attachment to your sir rebuttal testimony?
it is.
Do you have any corrections or additions you would like to make to that testimony?
I have one correction that I would like to make. On my FEA Exhibit 1.03, line 8, column 7, there was a cell reference error. It should read 5.81%. So the median growth rate under column 7 should be 5.81%. I believe it read previous to this FEA Exhibit 1.0.
Thank you, Mr. Walters. Now, if I were to ask you all of the questions in your testimony while you're under oath today, would your answers be the same?
Yes.
Mr. Chairman, I move to admit FEA Exhibits 1.0 through 1.16 and FEA Exhibit 3.0 and 3.01.
Thank you. Please indicate if anyone has an objection to that motion. I'm not seeing any, so the motion's granted.
Mr. Chair, could I ask a question of the witness? I just want to make sure I replaced the right number on your chart. Could you just state what number your previously existed there?
The version I was looking at did not have a number. It said FEA Exhibit 1, I believe.
Okay.
And it should be 5.81.
So it's immediately above that FEA Exhibit 1.
Yeah, so strike that line. So line 8 under column 7. So the median of average of growth rates would be 5.81%.
Thank you, I've got it. Sorry for the
No, you're fine.
digression.
At this point, Mr. Walters is available for cross-examination.
Okay, thank you. I'll go to Mr. Russell first. Do you have any questions for Mr. Walters?
I do not, thank you.
Ms. Schmidt?
No questions? Thank you.
Mr. Moore?
No questions, thank you.
Okay, Ms. Clark or Mr. Saban?
I have just a brief, one brief question for you, or a series of questions. Would you pass that up for me? Let me get mine out first. Good afternoon, Mr. Walters. Thank you for being here, and we'll hopefully get you out of here quickly so you can catch your flight.
Sure, thank you. Nice to meet you.
In your testimony, Mr. Walters, and if you could just refer to your direct testimony, it's on page 20 of your direct testimony. I just want to ask you a couple of questions about that.
Okay.
You'll see on that page, there's a question that starts with, "In light of higher levels." Do you see that question?
I do.
So if you wouldn't mind just reading the question, and then we're going to read the answer into the record, and then I want to ask you about that.
Okay, so you want me to read lines 12 through 20 right now?
Lines 12 through 20, and then we'll go over to, you have a figure CCW-4 on the next page. So we'll stop there, if that's okay.
Sure. Question. In light of higher levels of inflation, expectations of higher interest rates, and the war in Ukraine, how has the market perceived utilities as investment options? Answer. Since the end of the second quarter of 2021, utilities in general, as measured by the S&P 500 Utilities Index, have significantly outperformed the market as measured by the S&P 500, as well as the NASDAQ Composite. This is presented below in figure CCW4. This is indicative that utility valuations remain robust even during a period of elevated inflation, rising interest rates, and uncertainty as a result of geopolitical events around the world.
Okay, thank you very much. And then on the next page, figure CCW-4, you have a chart there which is representative of what you just spoke about above in that answer, right?
Correct.
And this data goes from June 30th, 2021, looks like through June 28th, 2022. Is that correct?
No. If you look at the top of the figure, it indicates that it goes through July 8th, 2022.
I
It's
saw
just
the
the way.
difference. I didn't see on the bottom where it had July. I was wondering.
It's just the way that the
Okay.
axes labels are because there's so many observations there.
No problem. It's true, isn't it, Mr. Walters, that that has not been the case from June through the present, right? That the utility stocks have substantially underperformed the rest of the market since then.
They have underperformed. They certainly have not made up for they've not closed the gap, if you will, that's depicted in this figure or in the figure that's at the back of this testimony.
We'll talk about that. I've handed you a cross-examination exhibit from S&P Capital IQ. You would agree with me, would you not, that all of the parties' experts in this case have relied in numerous places on the S&P Capital IQ data?
Yes,
Yeah.
sorry, yes.
And this is, let me just represent, this is a printout from S&P Capital IQ dated October 5th, so it's still a few days ago, but it's closer in time to the hearing than what we were looking at in your data, right?
Correct.
And here, I'd just like to read the top.
Can I clarify something real quick?
Sure.
So this data is only a subset of the continuation of an exhibit. So like I think this only represents the third quarter of 2022, whereas the other chart that we were referencing covers a year prior to that as well.
We'll come to that.
Sure.
I'm going to cover all of that information. So just at the very top of this, the title of this is Gas Utility Stocks Slumped in Q3, which is what you're pointing out, 2022, as pricey sector entered correction. And then we go down to the first sentence, and it says, gas utility stocks ended a streak of outperformance as central bank policy and other market forces weighed on the utility sector. Then the second paragraph says, a group of 9 utility operators selected by S&P Global Commodity Insights plunged 13.3% in the third quarter, sharply accelerating losses sustained in the prior quarter. So wouldn't you agree they're noting that there were losses in the second quarter as well?
That's the way that would read, yes.
Okay. Then it says, meanwhile, the S&P 500 fell 5.3%, and the S&P 500 utilities sector decreased 6.7% in the third quarter. Did I read that correctly?
Yes, you did.
And there in the chart below that, that shows a number of gas utilities, not utilities generally, but gas utility stocks in the third quarter and their performance, right?
Yes, plus the S&P 500.
Right. And you see that the gas utility stocks are performing well below the S&P 500, correct?
Correct.
Okay. Now, you pointed out that there were that there was a correction, or that that there has been performance earlier that was outperforming the S&P 500, correct? That's what you were saying?
What I'm saying, if you were to continue my chart on figure CCW4 to even accommodate this data in this chart, the gas index would still be outperforming the market since June 30th, 2021. So if you were to continue the data presented in figure CCW4, and similarly, the figure at the back of my testimony, figure CCW7, and I can go over the differences between the two if you would like, but the fact would remain the same, that both charts in my testimony, if you carried it through the data as of this chart, or this cross exhibit you gave me, they would still be outperforming the market.
Do you have a chart showing that in your testimony in the record? I should just say, do you have anything in the record that demonstrates that?
I mean, we can just take a look at the,
I'm just asking if you in your testimony or in the record, there's someplace we could go to find that.
yeah, I mean, you could take the performance of this chart right here, shown here, and line it up with the chart on here, and it would show that that's still not gonna be enough.
I think you're just misunderstanding my question, or maybe I'm not being clear. In the record, you have this chart that we've looked at in your direct testimony. You don't provide a further chart that updates that to the present, do you?
No, I have not provided that in testimony.
Right. And I just want to go a little further here into this document. If you could flip to page 2. Do you see that chart on the second page there?
The one of the gas utility stocks underperform?
Yep.
Yep, I'm there.
to me, that demonstrates, Mr. Walters, that of the three indices, the gas utility index that they're talking about here underperformed both of the others by a substantial margin. Wouldn't you agree?
So they underperformed. They fell 13.3% relative to 5.3% for the S&P, or 6.7% for the utilities S&P 500 utilities sector in general.
So they performed more than, they were worse by more than double, right?
Well, they were worse by 8 percentage points relative to being,
The S&P was at 5, right? Where are you looking? I'm sorry.
what I'm trying to say is, to answer a previous question you asked, if we look at the July 8th figure here,
Yep.
on my testimony, where it shows that the index is up 10.33%, the S&P 500 is down 9.26.
I think.
So if you just take the minus 13.3 from there, and it would just show that the gap is not closed and the utilities are still outperforming.
I guess what we're referencing two different numbers. On the first page, the S&P fell 5.3% in the third quarter, and the S&P 500 utilities fell 6.7.
That's correct.
The utilities fell 13.3, so more than double in the third quarter. It fell more than double over the other two.
Yes, and that was what I said. They fell 8 percentage points more.
Okay, now if we look at the second page again, I want to read one more thing. It's the paragraph that is underneath that chart. It says, and I'll quote, "Utilities provided a safe haven earlier in 2022, but their outperformance has faded even as investors remain defensive." And this is the part I want to focus on. Critically, the 10-year U.S. Treasury yield surpassed the dividend yield for the utility sector, which serves as a bond proxy. Ghastly, this guy said. Utility stocks also richly valued and outperforming fellow defensive sectors, healthcare, and consumer staples before the sell-off. So it is a significant development, is it not, that the 10-year U.S. Treasury yield has now surpassed the yield for the utility sector. That demonstrates that bonds, a 10-year bond would be a better investor choice than to go to a gas utility stock right now.
I also believe that the 10-year Treasury yield is at or higher than the 30-year Treasury yield, which is another significant thing.
I understand. Just to answer my question, that's true, isn't it? That if you're a rational investor wanting your best return and the 10-year has now exceeded the utility index, you'd rather go, or the utility yields, you'd rather go to the 10-year Treasury note.
If all you're investing in is yield, then yes.
Okay. That's all I have. Thank you.
Thank you. Major Buchanan, any redirect?
Oh, I'm sorry, I forgot to move to admit DEU Cross Exhibit 1 into the record.
Okay, thank you. If anyone objects to that motion, please indicate your objection. I'm not seeing any, so the motion is granted. Major Buchanan.
I do not have any redirect.
Okay, thank you. Commissioner Allen, do you have any questions?
No questions, thank you.
Commissioner Clark.
Hi. Just a couple of questions to understand the charts a little better. Looking at your figure CCW4, which addresses capital appreciation returns over a given period, is that measuring something different than the dividend yield?
So the capital appreciation return would not account for dividend yield or dividend return at all. The dividend yield or dividend return component of it would be captured in the total return, which I have provided in that figure CCW7 at the back of my direct. So and that's why you will also see a wider disparity or a wider outperformance of the utilities index relative to the market, because the utilities index pays a higher dividend yield than the market.
So these appreciation returns are measuring change in stock price?
Exactly, yeah.
That's my only line of questioning. Thank you.
Thank you for your time.
I think you answered my questions too. As I'm looking at comparing the exhibit that was passed out, the chart on the page 2 with your CCW4, obviously they're measuring two different things, but since this chart starts all at 0, so it's only comparing performance in one quarter, right? The exhibit that was handed out is looking at performance in one quarter starting at a baseline of 0 at the beginning of that quarter.
Yeah,
right?
so
Okay.
I'm gonna say it's exactly the same as my figure CCW4 minus the previous year. So mine starts at June 30, 2021. This chart that was handed to us today starts at June 30, 2022, with 0 being the baseline or the starting point.
So if I were to just through napkin calculations, try to compare these two, tell me if I'm doing this wrong. If I took the red line on your CCW4 that is up 10.33 and then subtracted 13.3 from that, would that get the results of where things are, and then do similar changes to the blue and green line?
Yeah, so that should be a pretty close approximation.
Okay. Okay, thank you.
Yep.
That answers my question. Thank you for your testimony this afternoon.
Thank you. Everybody have a good day.
Major Buchanan, anything else from you?
Nothing further.
Okay. Are we going to the Office of Consumer Services next? Is that everyone's understanding? Okay, Mr. Moore.
The Office of Consumer Services calls Daniel Lawton to the stand and asks that he be sworn.
Good afternoon, Mr. Lawton.
Good afternoon.
Do you swear to tell the truth?
I do.
Thank you.
Thank you.
Mr. Lawton, could you please state and spell your full name for the record and give your business address?
Yes, my full name is Daniel J. Lawton, and my name is spelled Daniel, D-A-N-I-E-L, Lawton, L-A-W-T-O-N.
Could you give your business address, please?
Oh, I'm sorry, I didn't hear that part. My business address is 12600 Hill Country Boulevard, Suite 275, Austin, Texas, 78738.
On whose behalf are you testifying today?
The OCS,
What is the purpose of your testimony?
to provide expert testimony on the current cost of capital.
Did you prepare direct testimony together with OCS exhibits 3.1D through 3.113D and cause this testimony and accompanying exhibits to be filed with the Commission on August 26, 2022?
I did, yes. On August, that is my direct testimony, filed August 26th.
Did you also prepare sure rebuttal testimony together with OCS exhibits S1S through, 3.1S through 3.2S and cause this testimony and accompanying exhibits to be filed with the Commission on October 13th, 2022?
I did. That would be my sir rebuttal.
Did you have any changes to this testimony you'd like to make at this time?
None that I'm aware of.
If I ask you the same questions that are contained in your written testimony, will your answers be the same?
They would indeed.
The office would move to omit the testimony and accompanying exhibits of Mr. Lawton.
Thank you. Please indicate if anyone has an objection to the motion. I'm not seeing any. The motion's granted.
Have you prepared a summary of your position you'd like to give at this time?
Yes, I have.
Please proceed.
Thank you. Well, Commissioners, thanks for having me this afternoon. It's been a couple of years, and we're still talking cost of capital, so I'll try to keep it brief. In this case, I address two what I think are fundamental issues that you need to decide to determine revenue requirements in this case. The first issue is the cost of equity. What profit level should we allow DEU to earn and embody in the rates? The second issue is is the capital structure, and should that be adjusted in this case before setting rates? So those are the two main prongs or issues that I bring forward today. Now, as to the first issue, I recommend a 9.20% cost of equity. That cost of equity is based on fundamental, tried and true models for determining equity returns. They're used not only at this commission, but commissions around the country. Combined with those models are current market data. I think my rebuttal shows the current market data goes through, I think it was October 10th. Now, why current market data is important is you've heard a lot, and you will continue to hear a lot, about inflation and rising interest rates. Well, if you're using current market data, you're incorporating those changes in your models. And I think every witness in this case has employed current models and current data. Now, the DEU, the company in this case, has requested a 10.3% return on equity. I think that's somewhat high, and I don't think it can be supported. And what I did is, in my direct testimony at around page 64, I laid out all the factors that I believe are problems in Ms. Nelson's analysis. For example, if you look at her constant growth DCF and quarterly compounded DCF models, they support an ROE closer to 9.4 to 9.6, or on average about 9.5. I explained that in my testimony. Certainly, they do not go as far as 10.3%. The other issue is with regard to her Ms. Nelson's capital asset pricing model, where I believe there are fundamental errors. And if you just look at the range that Ms. Nelson points out as a reasonable range of 9.6 to 10.75, and she picks a 10.3 final analysis, many of her capital asset pricing model results are well above that range. So her own analysis excludes her capital asset pricing model. I point that out in my testimony. Finally, with regard to her risk premium analysis, there is something fundamentally wrong. I address it. When interest rates are going up, cost of capital is going up. When interest rates are going down, cost of capital is going down. It does not make intuitive sense. If you look at it generally, when interest rates are rising, loans cost more. Cost of capital is rising. When cost of capital increases, the cost of equity increases. And I know Ms. Nelson tried to explain it, I think, in one question to the bench here, and it's just fundamentally wrong to conclude that as interest rates go up, the cost of capital goes up. I agree. But when interest rates go down, cost of capital also goes up. That's just fundamentally wrong. So I point out in my testimony with regard to Ms. Nelson's risk premium analysis. To be brief, I'm going to go to the capital structure. In the last case, I sat in this very chair and supported the 55% equity ratio that was part of a settlement for the company. And the reason is we had a Tax Cut and Jobs Act change, which caused deferred taxes to decline rapidly. And the company relies upon deferred taxes as cash flow for their financial metrics. Well, that was going to go away. So what this commission did and what the parties did was everybody got together and agreed on a higher equity ratio to solve that problem. Well, since then, a lot of things have happened. One, they don't have the cash flow problem they had, because when the Tax Act changed, that meant rate base. This company's investment capital, for which it earns a return on, will grow more rapidly. I point that out in my testimony. And so their earnings base that you're going to apply the return to in this case is much higher today than it would have been but for the Tax Act changes. So it's my opinion that the extra equity in the capital structure that this commission provided in response to a problem being created by the Tax Act is no longer necessary. And the cost to consumers of maintaining that is roughly $6.3 million a year in higher rates and millions in profits for shareholders. It's just not necessary. So that is the conclusion of my introduction, and I thank you for taking the time to listen to me. Thank you.
Mr. Lawton is now available for cross and questions from the commission.
Thank you, Mr. Moore. Ms. Schmidt, do you have any questions for Mr. Lawton?
No questions, thank you.
Thank you. Major Buchanan?
No questions.
Thank you, Mr. Russell.
No questions, thank you.
Thank you. Mr. Saban?
Yes, I do have some questions. Hello, Mr. Lawton. Good to see you again.
Good to see you, sir. How are you?
Great. I want to start with, there's been a lot said about this RRA results that we get across the nation. Do you agree, first of all, with Ms. Nelson that the RRA data to some extent is outdated?
No, it's actually up to date. I mean, Ms. Nelson put forth an exhibit that brought forth the latest data that RRA has. I believed it was through August 31st.
That was a poor question. What I meant by that is that it's taking into account historical data that is usually several months old from where we are today. Isn't that
Yeah,
right?
that's the way it works
Yeah.
when you have historical data. I mean, they can't forecast the
Exactly.
future. We wouldn't trust it then.
Right.
Right.
And you would also agree, wouldn't you, that there are times in our economy, in particular the last 3 years has been a good example, where we've had very sharp changes in economic outlook because of world events.
I think it's more than because of world events.
World events, and what would you add to that?
Well, the pandemic.
Okay, I was thinking that was a world event.
Oh, okay, I was thinking
Sorry.
about it localized to the United
Okay.
States. I was being selfish, I apologize.
Well, I think other people around the world would consider it a world event as well.
Yes, sir, you're correct.
In any event, and I want to emphasize something, as we talked today, you said something in your opening that I totally agree with, and that is
Thank you.
that what we care about the most right now in this proceeding is what is talking about what the current market data shows. And that was a quote from you that you said, current market data is what we should be focused on. You agree with that?
I don't agree with those exact words. I said current market data is what we all have employed. I don't know if I said we should all be focused on. I think it's important, absolutely.
Do you agree that we should be focused on current market data?
Absolutely, don't ignore it.
All right, great. So I want to just run through a couple of exhibits, and Mr. Mendenhall's kindly agreed to walk these around for me. And the first thing I want to talk about is, Mr. Lawton, is if you can open your direct up to lines 491 to 494.
You have a page number?
I can get you one. Give me 1 second.
Oh, I got it. I think it's page 28.
So in your direct, page 28, if you'd go there.
I'm there.
Are you there? Okay, great. And I just want to focus in, when you are talking about the RRA report in your direct, you have a note there on line 491. You say, as noted above, regulatory authority cost of equity decisions for gas utility rate cases for calendar years 2020 to 2021 averaged about 9.47% to 9.56%. And then you say during the first 6 months of 2022, the average authorized gas utility equity return declined to 9.33%. Did I read that right?
You did.
And then you're citing to an RRA report there in the footnote, is that correct?
Yeah, I am.
I've just handed you this is an updated version that goes of the same data from RRA. Let me represent to you that this goes through the end of September of 2022. And I just ask you to look down at the bottom and tell me what the year-to-date there shows.
The year-to-date there's two numbers. What would you like?
Just the year-to-date September average, and then we'll talk about the other one in a minute.
Okay, the year-to-date September average says 9.42%.
Okay, and you would agree with me, would you not, that that average is higher than 9.33%?
By By 9 basis points.
We're moving along great here. And then the next number below that, which you highlighted, would you read, that's the average post-June 30th number. What does that say?
It says 9.52%.
Okay. Also an increase from 9.33. We can agree on that, right?
Well, I think they're two different numbers.
They are. They are. I'm just saying those averages are higher. If you take the 6 months since June at 9.52, that's higher than the prior 6 months at 9.33.
It is indeed.
Okay. Now, if you'd flip to your surrebuttal testimony, and we're going to go to lines 491, oops, is that the same one? Hang on. It's 33 and 34, which is on page 2 of your surrebuttal testimony.
Did you say 33?
Lines 33 and 34.
Got it.
Are you there? Are you there?
Yep.
Okay, that shows that the, again, you say that, to point out Ms. Nelson's differential, you cite again to the same 9.33 average, and the footnote 1 goes to the January to June numbers, right?
It does indeed. Do you want me to say the same thing with these new numbers?
No, I think we've got those numbers, because the point is they're the same, aren't they?
Yes.
And your surrebuttal came even after we had more current data through September, right?
That is correct.
But you didn't update that number in your report,
I
did you?
didn't move it up 9 basis points. You are correct.
Okay, and then, gonna do the same, we pulled the most current we could find before, by the deadline for cross exhibits, and I'm gonna give you that one as well. While we're passing that around, Mr. Chair, I move for the admission of DEU cross exhibit 2.
I do have one question. It's a clarifying question, and if I may ask that.
Go ahead.
If I heard Mr. Saban correctly, he said the average post-June 30th to now was 6 months. Did I hear that correctly?
No, I just said, I intended to say the average from June 30th to the present. If I didn't say that, I meant that.
And so that's about 3 months, is that right?
I assume that's right.
Okay, that was just my question. I have no objection.
Thank you. If anyone else has an objection, please indicate it. I'm not seeing any, so the motion's granted.
Thank you. Okay, so Mr. Lawton, I've now handed you DEU cross exhibit 3, which is it's the rate case history from the same source through October, I believe this is through October 14th. They don't show the date on here, but I think it was through October 14th. You'll see there's a couple of rate case decisions that came out on October 10th and October 12th that are at the bottom that have been added to this from the September one. I'll just point that out for you. Do you see there's one,
Referring to 2 settled cases for your numbers?
I'm referring to the date. If you look at the date, you'll see that,
I see the dates, but you're going to refer to the settled cases
no, I was just telling you that there's been 2 additions added to this. The other one had settled cases too. The ones you're using they have litigated and settled cases.
I understand, but the 2 recent cases you're referring to were settled. I'm trying to clarify that, sir. It's your document. I'm trying to clarify, that's all.
That's right.
Okay. All right.
October 10th, 2022 and October 12th, 2022. Do you see those?
I see it.
Okay. All I'm wanting to point out for you and have you confirm is that the 2022 average now, as of the date of this document, has gone up to 9.44%. And then the July to October has gone up to 9.53%. Do you see that?
I see your numbers, but your methodology seems to have changed a bit.
This isn't my methodology. I just printed this, we just got this from RRA. This is their methodology.
And I don't recall RRA posting a number of average post-June versus average post-July. Your prior exhibit had average post-June, now you have average post-July, and if you're trying to make them comparable, you got apples and elephants.
I'm not trying to make them comparable, sir.
Okay, I'm just clarifying. The numbers say what they say.
Let me just ask this, do you have any reason to dispute any of this data?
Well, I haven't studied it all, and so your recent ones with these settled cases, I wanted to look at a little more closely that this recent settlement, that's all.
Okay,
No other disputes.
okay. So what I want to ask you is, it's true, is it not, that because of, to some extent, because of the world in which we live and the market we have, these numbers have started to shift back up, isn't that right?
Temporarily, we've seen a change, and for example, in your last exhibit, you see a 2 basis point change. In your prior exhibit to that, you saw a 9 basis point change from the 9.33, which was based on 6 months of data.
Right, and these.
And
oh,
if we
yeah, go
look at what happened in 2021, the numbers are still lower. Because I think 2021 for the year was 9.47?
It was 9.47 and 9.56, I think is what you had.
And these numbers are lower than what we had in the previous year. So you're trying to take a couple of incremental months of little changes back and forth and make a case, and I don't see it.
Well, I think we just established, you agreed with me that we would, the more current the data, the better for our purposes, right?
True, but if you're gonna take one data point, or as you did in your last exhibit, 2 data points on settled cases to make your case, I don't think it does it.
I don't think I've even referenced the settled cases. I'm just pointing out this is RRA data, that's all, sir.
Yeah,
Okay? So, back to my original question, you would agree with me, would you not, that since June of this year, the trend has gone back up? It's on an upward slope.
it's moved from, well, what's your starting point?
Well, I just said from June to the present, at least, from these documents, it was at a 9.33 according to your testimony, which we just looked at in 2 places, and now it's moved up from 9.33 to the yearly average is at 9.44.
9.44?
And the last 3 months, it's at 9.53.
Yes.
You agree with me that that's an upward trend?
Upward trend from the June of 22 number, a downward trend from 2021.
But an upward trend from when you submitted your direct?
That is true.
Okay. Now, why didn't you, in your surrebuttal testimony, update your RRA information to use the most current data, even though you reference it?
I had the document that I put in my testimony. I didn't have the next RRA.
Okay.
But I'll try to get that.
All right. Mr. Chair, I'd like to move for the admission of DEU cross-exhibit number 3.
Please indicate if anyone objects to that motion. I'm not seeing any objections, so the motion's granted.
All right. Would you agree with me, Mr. Lawton, that that trend has turned at the same time we've seen other economic indicators turn more negative in the market?
Which indicators are you speaking of? I don't.
For example, inflation, treasury yields are going up, federal interest rates are going up, quite markedly, inflation is going up.
The premise to your question is incorrect. If the trend, if we look at inflation, for example, if you look at the July numbers for inflation, they were, what, 8.4, 8.3? I think the more recent one was 8.2 annualized basis. So if you say inflation's going up, the answer was, technically, it didn't. It actually ticked downward. So if you have another metric you want me to look at, look at it.
I think I was asking for taking all of those into consideration. That
Taking them all into consideration, inflation went down, some other financial indicators or metrics might have become more negative, and you've shown that 9 basis point change in 2 months.
Okay. Let's go, I'm going to show you another cross-exhibit, Mr. Mendenhall will bring around.
Hey, thanks.
I'm showing you a volatility index that was updated through October 13th, 2022. This comes from the Federal Reserve.
I see it.
You see it?
Yes.
And I just want you to, there is this similar report in Ms. Nelson's testimony, but this one goes out further than hers does. This is the most current we could get before the deadline for cross exhibits. If I look at February 2020, sir, when you were here when that was going on, and I look at the volatility index on that, on approximately that date, it's, I think she represented it was at 14 or 15. You see that on the left-hand side there?
Yeah, I would see it at the bottom of that largest peak on that page.
I agree, yeah, same spot, right around there, about 14 or 15, right?
I don't know the answer to that. My eyes aren't that good. I
Okay.
even tried using these glasses and they're not working either.
All right, we can agree, can we not, that today, September 2022, the VIX index is reporting more than double the volatility from that February of 2020 period?
Yeah,
Okay. So,
but not necessarily for utilities. They're reporting it, this is based on the S&P 500.
I didn't say it was just for utilities.
Okay, I just
I'm
want to
pointing out to you that the VIX index is double the volatility overall over what it was in 2020.
Absolutely.
Okay, so you were asking me a minute ago what things have changed. That has changed, has it not, between 2020 and now?
It has changed, and what you haven't shown, or what I can tell you, it's not relevant to the utilities. You show me a utility whose volatility has doubled. I don't think you can, sir.
I don't think anybody's representing the volatility has caused volatility to double. I think we're
We're
trying
here on a
to,
utility case to set the rate of return for your client. And why we're talking about the volatility of some private corporation out there, that's fine, but it's not relevant to what we're doing.
okay, that's your position, I understand it. All right, we're gonna show you another exhibit, and I should make sure I move, Mr. Chair, I move the admission of DEU cross exhibit number 4 into evidence.
Please indicate if you object to that motion. I don't see any objections, so the motion's granted.
All right. Mr. Lawton,
Yes, sir?
I'm just going to point out a few things. You would agree with me that the U.S. bond market is relevant to what we're doing here, isn't that true?
It is.
And the volatility in that sector, according to this document from S&P Capital IQ, is at its highest point in volatility since the pandemic in March of 2020, right?
Based on the ending date on this chart of, I don't know what the ending date is.
I think this report says of September 30th, 2022, so a few days ago.
Okay. Then as of the date of this report, because it looks like the numbers go beyond the last date I have on the chart.
Right. This appears to show that on September 28th, this is what the date of this volatility index was reporting. You see that in the second paragraph?
I do.
Okay. So that is relevant to us, isn't it? Is it not, that the bond market volatility is significantly higher than it has been since the pandemic?
That is, but on New Day, what you're worried about is the market in which you approach and what the yield spreads are gonna be and when you need to borrow.
Well, speaking of that, let's turn the page on that document.
Okay?
You'll see that there's a chart there on page 2 that talks about Treasury yields, and you incorporated Treasury yields into your analysis, did you not?
I did.
Right. And Treasury yields over from 2022 to the present, to September of, it's the bottom of the chart says through September 28th, 2022. They have, quote, soared in 2022. Do you agree with that?
Where's the quote, sir?
Up the very top of the page, above the
Treasury
chart.
yields have soared 22 basis points. Yes?
And what they're reporting there in the first paragraph under the chart is that U.S. government bonds yields have soared this year as the Fed has hiked rates by 300 basis points and plans to continue hiking into 2023 in its ongoing battle to curb the highest inflation in 40 years. So first, you weren't looking at that, so I was going to ask you if I read that correctly, but
Well, I agree with, because
Okay.
I'm familiar with the numbers, and by the way, it's in my direct testimony on one of my exhibits, I talked about it.
well, you don't use we'll come to that in a minute, but you don't use the current increases in the federal bond yields. You use you use an older version.
I'm sorry.
We'll come to that. It's,
No, I need to answer that question. I believe I used as of October 10th in my risk premium analysis and my SIR rebuttal testimony.
we'll look at it, and you can correct me if I've misread your testimony, but I don't believe you have. Wouldn't you agree with me that a 300 basis point increase in government bond yields is a significant change in the economy?
Well, compared to where they were, absolutely.
Right, and that means, as you said a moment ago, that when yields are going up in the government bond market, that tends to drive up these equity returns as well, right?
Not equity returns, but the cost of equity.
The cost of equity,
Right.
yes.
Equity return is dependent upon what the utility does with its
Right.
expenses and gets a return.
Fair point. Do you agree that we're in the middle of the Fed dealing with the highest inflation in 40 years?
Well, that's a fact.
Okay. I want to read that second paragraph under the chart with you, if you can look at that. It says, as yields have risen, inflation appears to have peaked, even though it remains well above the Fed's 2% target. The Consumer Price Index, the market's preferred inflation metric, jumped 8.3% from August 2021 to August 2022. You would agree with me that that is a significant negative change in the market, that to have inflation increase that much in that period of time?
Yes, it's a concern, inflation, but we've also seen, as I pointed out earlier in this cross-examination, that it has not kept increasing at those levels. Actually, it's ticked downward.
But that is a relevant factor, that inflation increase, which you've taken into account, and so has Ms. Nelson, and so have others. That's a significant market change that tends to drive costs up for the utility.
Right, and as I said in my introduction of the testimony, we all looked at current market data. We all employed current market data. I came out at 9.2% using that data in those models. Your witness has different ideas.
Okay, let's go down to, last thing I want to cover on this document is just on liquidity. You'll see there's a statement there about liquidity issues.
I see it.
It says with volatility high and the dollar strengthening to record heights, liquidity in the 23.7 trillion treasury market is under severe pressure. That means, sir, does it not, that the Fed is essentially not, it's getting out of keeping interest rates low by buying up government bonds?
It's not, it's getting out of that,
Right.
the quantitative.
That's what I mean.
It's quantitative tightening, yes.
Yes.
And so that limits the liquidity in that market.
Right, and liquidity impacts us here because with the drop in liquidity, you have, that funnels through the entire market, does it not, and affects everybody?
Well, it does in the treasury market. If you're implying that suddenly your client, DEU, has less liquidity, I think you're wrong. I mean, you have.
No,
Okay.
I'm
I
talking only
just
about
wanna
in the bond
clarify.
market.
I'm sorry, I don't mean to talk over you, sir.
It's okay. Mr. Chair, I move to admit a DEU cross-exhibit number 5.
Please indicate if you object to that motion. I don't see any, so the motion's granted.
All right, just a couple more. All right, Mr. Lawton, I'm showing you what is a news release from the Bureau of Labor Statistics.
I see it.
We'll mark this as DEU Cross Exhibit 6. Do you recognize this report? Is this something you have reviewed?
It is.
Yeah. And would you agree with me that it's one of the authoritative sources we look to when we talk about inflation?
No.
No?
No, it's an authoritative source when you're talking about the consumer price index.
Sorry.
There are other measures of inflation
Thank
where
you.
you would have to go to other agencies.
Fair enough. The Consumer Price Index.
Yes, sir.
I'm just going to point out one thing, two things. At the end of the first paragraph, you'll see that last sentence. It says, over the last 12 months, the all items index increased 8.2% before seasonal adjustment.
Yes, so that's the one I mentioned earlier when I
Yes.
said it had ticked downward.
Okay, and I think you're referring to that, so we're clear, down on that fourth paragraph, is this what you're referring to where it says the all items index increased 8.2% for the 12 months ending September, a slightly smaller figure than the 8.3 increase for the period prior to August?
Not only referring to that,
August.
but the July number as well.
Well, the point is, between August and September, you had 8.3% to 8.2%, still above an 8% increase in the consumer price index.
That is correct, and it ticked down from July as well, as I pointed out earlier.
All right, Mr. Chair, I move to admit DEU Cross Exhibit 6.
Please indicate if you object to the motion. I don't see any, so the motion's granted.
Okay, one last chart about the economy I want to talk with you about. And then I'll refer you to your testimony, but we'll pass this out first. We're going to mark this as DEU Cross Exhibit number 7. And I'll just ask you, Mr. Lawton, let me represent to you, this is a printout from the Fed dated October 14th, 2022, so just a couple of days ago.
Yes?
Would you agree with me that this is their formal printout of the interest rates as of that date?
This is the daily printout of the H15 database.
Correct. So that shows the interest rates for that day on various federal funds, Treasury maturities, and other items.
Yes, as well as inflation index funds, which you'd find on the bottom.
Correct. Okay. So if you could now open your surrebuttal to lines 69 to 71, which should be on page 4. And line 69 to 71, could you just read that first sentence for us,
Into the record, sir?
please?
Okay. Yes.
Go ahead, the next sentence.
Okay. Since the August 26, 2022 filing of my direct testimony, interest rate yields for 30-year U.S. Treasury bonds have increased from about 3.2% August 26, 2022, close paren, to about 3.67% October 4th, 2022.
Okay, so first thing I want to point out is, it's true, is it not, that as of October 14th, that number has increased up to, for the 30-year Treasury rate, has increased up to 3.97%. And I think we heard this morning from Ms. Nelson that it's now above 4%.
This data is probably from, would you say, this is the 14th?
This is October 14th on this exhibit.
Yeah, I thought I saw a number of 4%, but it may be.
And you would agree with me that the 3.97% and 4% are both above the numbers you just read in your surrebuttal testimony.
They're both above 3.67%.
By as much as more than 0.30%, right?
No.
3.67 to 4%?
Yeah, and that would be 3.33%, right? To 4?
I'm sorry, I'm just trying to point out the difference between 3.67 and 4%.
Didn't I just say it? 0.33?
Well, I see what you're saying. Yes, 0.33, thank you. Yes,
You're welcome.
I follow you. So the number you used in your direct, you note that there's been an increase in your surrebuttal, but I note that you didn't include any of the October data that you noted had gone up even further in your 30-year government bond yields analysis in your surrebuttal.
I'm not understanding that question.
Go to Table 3, which is on the next page, if you will.
Yes.
Do you see there that you use July, August, and September data, and you don't use the October data that says gone up 0.33% more?
Yes,
Okay.
there's a reason.
I understand there's a reason. I'll come to that in a second. What I'm wondering is, when I look at these, would you agree with me that since the time you filed your direct, that government bond yields or treasury yields have gone up? They're on an upward trend.
The trend, nobody's discerned, there's certainly upward trend from where they were currently at that point in time. But you referred me to my table 3, which is monthly data. I did not have the month of October because the month of October was not finished yet. It still isn't finished, so I could not put in a comparable full month of interest rate data. The last month available was September.
I understand. That wasn't what I was asking. So let's go back to my question.
Oh, okay.
Let's do this. Go to your direct and go to table 12, which is on page 50, please.
I'm there.
Okay, do you see in table 12, your May 30-year U.S. government bond yield number is 3.07?
Hold on a second. I was on the wrong table.
Okay, no problem. It's table 12.
Table 12?
Yep.
I'm there. Go ahead.
The May number you used for the May of 2022 is 3.07% for that
Correct.
very same 30-year U.S. government bond yield, right?
Yes.
Now, if we look at your surrebuttal, it's gone up from there in this full month of September to 3.56, which is 0.49% higher, correct?
I don't know what you're talking about. Hold on.
Sorry.
I've got table 12 open from page 50 on my direct. I've got table 3 open from my surrebuttal. Now,
Okay,
you asked me to look at the May number of 3.07.
You see that, and we agree that that's the number you used, right?
Yes.
Now, if you go to your table 3 on your surrebuttal testimony for September of 2022, it's gone up to 3.56. Do you agree with me?
I agree. Those are the numbers.
Okay, so that's a 0.49% increase there.
But, yeah, but you're skipping over a couple of months. I mean, first of all, these are monthly sequential numbers, and what I use is a 3-month average. You seem to be taking it out of context and want to grab a month from one period and compare it to 3 more periods away. It makes no sense to me, but.
If I were to draw a line from May on a chart, if I charted all of these numbers and I drew a line from May to September, you would agree with me, would you not, that the line would be an upward trend?
It would be an upward trend with a downward part in July.
Okay, and if we added October today, or through the current numbers in October for the 30-year Treasury, that would even be, the line would even go up higher than that, up to 3.9%.
What is your October number, sir?
I said if we're using through the current daily rate from 3.07% in May, that trend would go up even higher, I said. That's correct, isn't it?
No, because you're again comparing apples and elephants. One, this is a monthly number, and now you want me to look and compare monthly numbers to daily changes in your Exhibit 7?
So if sir, I understand why you're fighting me on this, but
I'm not fighting. I'm trying to.
if I just
understand.
take the Treasury and I plot it from May of 2022 to October 14th or 15th or 16th of 2022, that line is going to go way up.
It's going to go up, and it's going to go down in parts and go up in parts.
But from the beginning where it started to where it ended is going to be much higher than where it started.
Right. It's like the rate of return that it's been authorized in our first exhibit, the RRA numbers, they continue to decline downward. We talked about that, the 3.46% down to the 9.33%. But even your updated numbers are lower than last year, so we have a declining trend there.
So let me just represent and see if you'll agree with me that from May of 2022 to the present, there's been a 0.9% increase in the 30-year Treasury yield. That's true, is it not?
I'm not following that question. Say it again.
From May, when you submitted your direct testimony, to the present, there has been an increase in the 30-year Treasury yield of essentially 0.9%.
Yes.
Okay.
From 3.97 down to 307 is what you were talking about, or 307 up to 3.97, using the date of
Correct.
October 13th.
All right, Mr. Chair, I move to admit that exhibit is DEU Cross Exhibit 7.
Please indicate if anyone objects to that motion. I'm not seeing any, so the motion's granted.
Now, you criticize Ms. Nelson because you say that her numbers are unrealistic or too high, the ones she uses for the 30-year Treasury yield. Isn't it true that the numbers we're looking at present are higher than the numbers she uses in her report to calculate her, that she uses for her risk-free rate?
I think you've asked 3 questions that I figured out there, and could you break it down to one at a time, sir?
I think I asked one question.
I think it was 3, but go ahead.
Is it? Okay. You criticize Ms. Nelson
Yes,
for saying that her risk-free rate is too high.
yes.
Isn't it true that the risk-free rate using these figures is higher than the number she uses in her direct and rebuttal testimonies?
It is true, but can you point to me where I criticized her for her risk-free rate was too high? Could you, I'm trying to recall.
She was using a forward-looking figure, and you said she shouldn't be using an estimated figure, that estimated figure was not correct.
That
And
is
I'm
correct.
That's right, correct?
I did not criticize her for using a too high a number. I criticized her for using a forecasted number with no relevant background to support that forecast.
Okay, now and thank you for that clarification, and I'll just follow it up by saying she was not only right in her estimate, she was even less than what the market's actually done. That's true, right?
That's true, and she came up with 10.3% back in February before any of this happened.
All right. So I just want to talk with you a little bit about if I took your risk-free rate and we factored in the current number, and I get you didn't do that, and I get you disagree that we should do that. You use a 3-month average. Ms. Nelson disagrees with your using of a 3-month average. I don't want to get into that debate. What I want to know is just if I use the risk-free rate that is in place today, it's true, isn't it, is it not, that would move your number significantly upward?
Well, significant's a relevant term. Why don't we look at the numbers?
It would move you from your direct from 3.14 up to 4%.
Up to 4% if you use the daily spot, yes.
Right, and if
And I did that, and we have the number. I did that on my exhibit, it would be in my rebuttal testimony, did the calculation, at least close to your 3.9 or 4%. If you look at OCS, this is rebuttal, 3.2.
Hang
And,
on, let me follow you, let me get there, hang on. Exhibit 3.2,
yes, sir.
okay, I'm there, go ahead.
Okay, and if you look at the bottom in column D, it says spot. I used a 3.8%.
Hang on, I need to find out where you're at. So
Okay.
I'm looking at that exhibit, where in that exhibit are you referring to?
At the bottom of the page, you'll see a G, a D, and a D.
Hang on,
Look at the middle,
I
no?
must have a different, I'm looking at OCS 3.2?
Yes, in the rebuttal, sir?
Oh, I must have the direct. Give me 1 second. I apologize. I'm trying to follow you. Okay, there it is.
Yeah.
So 3.02,
If you look at the middle column at the bottom, you'll see that says spot. That's a 3.8% treasury yield. And I also use a 3-month treasury yield that was updated at 3.3%. Ends up at 10.08% at the bottom and 9.79% range. So,
Right.
yeah, it does have an impact, and when you factor it into the other models, overall, what the rebuttal shows, doesn't change much.
in fact, from your direct, your surrebuttal, despite these market conditions we've just reviewed, you didn't change your recommendation at all.
Nobody in this case did.
I
I
understand.
didn't, because the models don't support changing it. I would have to, assume all the work I had done was for naught and make up a number. I wouldn't do that.
Let me go back to my question, make sure we have it clear on the record. between your direct and your surrebuttal, and despite all of these conditions we've just reviewed and all of these cross exhibits getting worse and worse over these months between your direct and your surrebuttal, you didn't change your recommendation one iota.
That is correct, because all the models, and if you look at the summary, and I updated it and provided it to you, sir, it doesn't support changing it, and if you look at page 3 of the surrebuttal.
All right, we're gonna move on. All right, could you refer, please, with me to your direct testimony?
Okay.
And I just accidentally closed it, so let me open it back up. And we're going to go in your direct testimony to line 399, which is on page, that's on
Page 23?
23.
I'm there.
Yep. I want to make sure I understand a position you take in this and your surrebuttal testimony. I think you were explaining it in your opening with the commissioners, but I want to make sure I understand. I take it from your table 8 there that what you're trying to represent is that when the U.S. Treasury bond is, when U.S. Treasury, the 30-year U.S. Treasury bond yield is moving, it does impact the ROE, but it impacts returns to a lesser extent than the actual movement of the bond yield. Is that correct?
Yes, that's based on 40 years of history.
Right, and if I'm looking at your chart, it looks like in where you've got the bond yield moving, your representation is that I think that the returns move about half or less than half of the movement you see in the bond yields.
Correct. If we've seen since 1981, interest rates falling many times precipitously, equity returns as authorized by commissions around the country have gone down, but at much slower rate. They've been sticky, and they don't move in tandem. And so debt cost goes down about 58 basis points. I think equity costs went down over the same time period about 28 basis points.
Okay, so I think you make that point here at the bottom, which I want to make sure we all see. The bottom of page 23, you explain that, and there's two sentences at the bottom there, which I'll read to you, and then would like to ask you about a couple of sentences. You say, for the period 1981 through 2021, the average of the absolute value change in the 30-year U.S. Treasury bond yields is about 58 basis points.
Correct.
For authorized gas utility equity returns over the same period, the average absolute value rate change is about 26 basis points, or just slightly less than half.
Yes, sir.
Right, that's your point there. And then you make this comment, thus, while it may be correct to conclude that debt costs will increase over the short term, equity cost increases should be of a smaller magnitude.
If history is to hold, if we're to learn from 40 years of recent history.
Yeah, I'm just reading what you're saying. That's your position, right? That if bond yields are moving, equity returns are moving about half or just less than half than that.
Over a 40-year time span, haven't analyzed the amount of movement in any given year to coordinate or calculate what if we see interest rates change today, what would be the expectation in the next period.
Well, your chart is year to year.
Excuse me, I wasn't finishing my answer.
Go ahead.
I apologize, I don't mean to talk over.
I would object.
You finish your answer, and then I'll ask mine.
Let me hear Mr. Moore's objection before Mr. Lawton continues.
Mr. Saban is not allowing my witness to finish his testimony, and I was under the impression from earlier today that you would give all witnesses some latitude in addressing the questions.
Yes, I do intend to give latitude to the expert witness, so Mr. Lawton, please continue.
All right, and I'll be careful not to talk over as well. As I was saying, over 40-year history, the numbers we just discussed, 58 basis points for debt on average and 26 basis points for equity.
Yeah, and
Now, I have not analyze the direct impacts I would expect in today's market. I'm just telling you a global trend over 40 years of history. And that completes my answer.
Thank you for putting that in so that I don't talk over you. On your chart, you do it's an annual number you're representing there from 1981 to 2021, right? It's annually, you're showing the trend lines on both of those.
Yes, and if I might, and this might help even more, if you look at OCS 311, 3.11,
Hang on one second. Is that 3.11 is your, with your
Correct.
direct? Okay, give me 1 second. 3 point,
let me know when you're there.
I'm getting there. It's opening. Okay,
All right, and you'll see the numbers, the years in the first column. The interest rate or treasury yield from 81 downward is in the next column, and then the authorized ROE.
sorry, hang on 1 second. I'm getting there. You have it in tab form. Go ahead.
Okay.
I'm there.
Okay, you see the years starting in 81 through 2021. The next column would be the treasury yield all the way for those corresponding years. And then the next column, in column B, is the authorized equity return.
Oh, that's very helpful, actually.
And so what I did is took the absolute value of the equity return and the absolute value of the change in bond return to calculate those numbers. And these numbers are the basis of the graph you were looking at.
Okay, that's helpful. But, so the point is, you've taken the data for every year over that 4-year period, and you're seeing the same correlation over that period of time.
No. It's not the same correlation. It's the average over 40 years. We might have different numbers for different segments of this 40-year history, depending upon what happened in those periods. I was making the point, if you look at the history of the data over 40 years, on average, these are the results.
Yes, and I think we agree that that's what I was talking about, too. I wasn't talking about anything else but that.
Okay?
Okay.
I'm glad we're clear.
All right, so now in your SIR rebuttal, if you'd go there, sir, to lines 119 to 127. 119, you'll see it's on page 6.
I'm there.
Oops, let me make sure I've got that right.
7, page 7, isn't it?
Hang on, I'm sorry. I opened the wrong document. Okay, 119, line 119, it's on page
7?
7, yep. And you're making, are you not the same point here when you, in that second full sentence that's, or first full sentence that starts the annual decline? You say the annual decline in equity costs is much slower, while debt costs have declined by larger margins annually. For the periods 1981 through 2021, the average cost of the absolute value change in the 30-year U.S. Treasury bond yields is about 58 points, and then you go through and talk about the 26. That's the same point you're making here,
Yes.
right? And then you make this different. You add one sentence here that's not in your direct. In line 126, you say, the result of this comparative analysis is that while debt cost may be increasing in the short term, any expected equity cost is less than half of the level of the debt rate changes, right?
Yes, that's what it says, and I disagree with your question of that I didn't mention that in my direct. I think I did mention that it was about half in my direct.
No, I just mean that sentence, the way you say that is different. You added that sentence to the other. I'm
Yeah, I didn't copy my direct. I wrote this fresh.
I wasn't suggesting you were. All right, so here's the point I want to make with that. We've kind of gone through both your direct and your SIR rebuttal on that point.
Yes, sir.
If we took your logic and applied it to what's happened over the last year, or actually since 2020, if we take February of 2020 to the present, and we've had this substantial increase in U.S. Treasury bond yields, and I think we have established in just this year, it's been a 200 basis point increase.
That's incorrect. I think it's 300.
In the 30 year, it's been, I believe, I could be wrong, I thought it was a 200 basis point increase, but if you want to say 300, I'll take 300.
I'll take yours. You're the expert.
So if we half that, that would be a 150 basis point increase, right?
Yes.
And so even if I take 40%, of that number, it's still more than a full percent increase, right? Okay, so if I take that increase and I apply it on top of what was the prior risk-free rate, that puts us right near, that puts us, if I take the number just, I'm asking this a poor question, let me try this again.
Yeah,
If I just take the period from when you did your direct to now,
yes, sir.
and I do 80% of that, we'd said earlier, it's a 0.9%. I take 40% of that, your number moves up significantly from where you are, isn't it true?
No, it'd be, I think if you took 40% of that, that would be, what would that be, of the 80 or the 90? Which one are your number? You've mentioned many.
Let me try that again, because I want to make sure we're clear.
Okay.
So I have, and maybe I've, excuse me, give me 1 second.
Sure.
I'm trying to, oh, excuse me, I remember where they got the number from. Now, from the last rate case to this rate case, there's been a 200 basis point increase in the U.S. Treasury yields for the 30-year.
I don't recall the number in the last rate case, and when in the last rate case are you speaking of?
Well, the numbers that at the date of the commission's order, that's what the number was. We're 200 basis points higher than that.
That I'm not sure of. It was in February 2020, the commission came out with an order. Do any of your numbers show that Treasury? Oh, we can go to my direct testimony. I've pointed the number. My direct testimony, 2020, shows about 153. I wish I knew what it was in February 2020.
You're showing a 1.53%.
That was an annual number, yeah.
Okay, so between then and now, we're more than a 200-point basis increase then.
Yes, if you compare the annual
Right.
number from 2020 at that point to a spot yield today.
So I'm just going to let's just use a round number at 200 basis points.
Got it.
If I take 80% of that, sorry, 40% of that, that's an 80 basis point increase. Do you agree with me?
40% of it would be 80 basis points.
So from a 9.5%, that speaks that we would be up above 10 in just that increase alone.
Well, you know, doing your approach, I think I started at the beginning of this as you've been going down this trail, that I said you'd got to look at the data for intervening periods. The basis point analysis that I did is over a 40-year history. If you want to look closer and use that kind of historical data and determine what kind of adjustments should be made, we can do that.
Well, I don't think you're answering my question.
I think I did.
Don't you agree that if we tack on an 80 basis point increase from where we were in 2020, that puts you above 10%?
No, I don't think so.
From 9
Let's go through it.
I thought we just did that.
No.
9.5% was the rate in 2020, February
Yes,
2020.
it was. It was the
Right.
ROE.
And I'm suggesting, and I think you're agreeing, that we're over a 200 basis point increase
Correct,
in that 30-year Treasury yield.
correct.
If by my math, we took 40% of that, that's 80 basis points. I add 80 basis points to 9.5,
You'd be at 10.3.
10.3.
Yes, sir. That's where you'd be at, but we don't set return on equity by taking the commission's last decision and start adding things to it. We start over, as every witness has done in this case.
I understand.
Yeah, I mean, your approach is nonsensical. Nobody would do that.
Let's do another one, which is your opening rate in your direct testimony was, I think we just established, was 3.07 in May.
Yes, sir.
That's the number, right?
The month of May.
The month of May, right?
Yes.
And from that to now, we agreed was a 90% increase, a 0.9% increase,
0.9% increase.
right? So if we take and do 40%, even half or 40% of that, your number should move up,
36 basis points.
right? And
If that's what you want to use as the metric.
I'm just saying, if I take your 9.4 and tack on to that the 0.36 basis points, you're up almost to 9.8%.
No, sir, you start me off at 9.4. Now you're adding numbers to my own testimony. I started off at 9.2. You got me up to 9.4. Where'd that come from?
Excuse me, yeah, you're right, 9.2. I apologize, you're absolutely right. But if you add that, you're above 9.5% at that point. But you
Yeah,
didn't make,
if you want to add 36 basis points to my 9.2% recommendation, that's the end result. It would be wrong, but that's okay.
but that's what the market is telling us in the yields, is it not? The yields have gone up that
The market
much.
isn't telling us to do that. The historical average analysis shows that result.
Okay, so-
There's no market telling you to do that. There's no market model telling you to do that, and there's no model in finance that tells you to do that.
What I mean, and I appreciate it, and this will be the last, we'll move on. What I mean is, you've just showed us, as we looked in your direct and your surrebuttal testimony, that they move about, that the yield and ROEs move together, but the ROE moves just about half or just less than half.
Historically, that was it. Yes, sir.
And that's your position,
That's my report of historical data.
right? And if we just apply what's happened this year, according to that data you're reporting, that would mean the ROE should be much higher than what you're recommending.
Much higher is a relative term. You established a moment ago, using that analysis, it would be at 9.5. Combined with the other models in this analysis, would still be back at 9.2. It's not getting you there.
You agree with me, though, that it would change your numbers in your surrebuttal testimony up from where they are?
I think I might have to say no to that. Just give me a moment. I would say no. It would lower them.
It would
It would lower the numbers, yeah. Because if you look at OCS Exhibit Number 2 from my surrebuttal, it shows a risk premium result. And I think you wanted to substitute your 956 for the numbers here, and these numbers indicate an ROE of 979 to 10.08. If I substitute 956 instead of this model, my ROE comes down.
That's not what I meant. What I meant is if you substituted in the increase through the present in your modeling, which you did not include all of them, you included only a 3-month average, your number would go up higher than it is for ROE, isn't that right?
Your question's wrong, sir. If you look at this exhibit we just looked at, you said I only used the 3-month average. We went over this earlier. I used a spot yield of 3.8 and a 3-month average of 3.3. I used both. I did not limit it to a 3-month average. I used the spot yield as of October 4th, 2022, while I was writing this testimony and submitting it to my client.
And my only response to that, sir, is that in your direct and surrebuttal testimony, you don't mention 9.8 at all. You only mention, you only mention the 3-month average. You don't mention that you account for the other anywhere.
Let's go. Number one, if you look at that exhibit that I just pointed you to, which is Exhibit 2, it says spot yield 3.8. The note at the bottom of the page tells you the spot yield is from the Federal Reserve on October 10th, 2022. If you look at the table on page 10, table 5, it shows the 9.79 to 10.06 risk premium results from that analysis. I believe if you look at, let's see where I talk about that a second.
Sir, I'm going to take you just to your testimony where I was referring to. We just went over this in both your direct and surrebuttal testimonies, Table 3 in your surrebuttal testimony, and I think it was table, let me find the other table. It was Table 12 of your direct testimony. In both of those cases, you use a 3-month average. You don't mention anything about using any other numbers in calculating your risk-free rate.
Which did you refer to in my direct testimony?
Table 12
Okay.
in your direct testimony and Table 3 in your rebuttal testimony. That's where you represent how you calculated the, in fact, the question above in your direct on line 911 is, what risk-free value did you employ in your CAPM estimate? And you say, I used the 3-month average of the 30-year Treasury bond rates, and you have the chart below it. You have nothing in here or in your rebuttal that say you used any other rate.
Okay, can I
And
respond now?
yes,
Are you
please.
done?
Yes,
Okay.
please.
Please go to OCS 3.11. Let me know when you're there.
I am at 3.11.
If you see in column D at the bottom, it says spot 3.2. The 3-month average is to the right of it at 3.14. And the note tells you that the spot was employed from the Federal Reserve data as of August 19th, if my eyes are catching me. So yes, it's in my direct, both the spot and the 3-month average. If you go back to my rebuttal, exhibit number 2, 3.12R, I guess it's called. You'll see the spot yield of 3.8% and the 3-month average of 3.3%, both producing different results. They're in the testimony, they're addressed, so the premise of your question is somewhat incorrect.
Can you tell me in your direct?
Let's take a quick break right now. We're a little overdue. I think.
Thanks.
Why don't we come back at 3:20? Thank you.
on. That should be working now. Is that better?
Yes, sir. Thank you.
Just want to wrap up this topic. So we have had lots of disagreements, and it wasn't my intention. But I just want to sum up. I want to make sure, as I understand your direct and surrebuttal testimonies, you're saying that history has demonstrated that the 30-year Treasury yield, when it moves, ROEs move about half or less than half of that figure, historically speaking.
Yes.
And so whatever the increase in the basis has been over this period of time, from your direct to present or from 2020 to the present, that you would expect that the ROEs in this case would be consistent with that 40-year-old principle.
Yes.
Okay. And so if we were to go back and look at February of 2020, and we looked at the analyses that were done, and we looked at what the ROE that came out was relative to the Treasury yields in 2020, and I fast forwarded to now, I should see that same correlation coming forward if the ROE in this case was if we set the ROE appropriately in this case, we should see that same correlation.
Yes, and we established that if we used that correlation and applied it with my models, that the number would come down from what I presented in the updated surrebuttal.
No, I don't think we do agree with that, but that's because you and I have a disagreement about which numbers are being used where, but that's okay, I don't want to get into that. I understand your position.
Let me just ask Mr. Lawton, for purposes of the streaming, to try to stay close to your microphone. I think the streaming's not picking up. We can all hear you fine, but I want those who are listening remotely to make sure they can hear you too.
I got it, sir. Thank you.
So I know we have a disagreement about what numbers go where and whether you've included them or not in your analysis, and I understand your position, sir. I think we've got the principle on the record, and is just a final point. If this commission applied your theory and they were wanting to figure out how to do that, they could do just what I said. They could look at what were we at, what was the Treasury yield in 2020?
I'm going to object. This has been asked and answered several times.
Mr. Saban, do you want to respond to the objection?
This is my last question. I was trying to sum up, but if you think it's been asked and answered, I don't want to offend anybody, so.
I think there's a good argument that it has, but we've been considering the leeway that I'm trying to give to witnesses. I think I want to give a little leeway on asking the question one more time. So if you want to phrase it a little differently.
I'm happy to. I guess what I want to do is make it practical for the commission that has a decision to make in this case.
Yes, sir.
If they were to go back and look at what equity premiums were when they made a decision in 2020, and they compared that to the equity premiums that are in place now, or whenever they make their decision, they could apply your principle and do that calculation themselves. And according to your testimony, they should be able to come up with a number on ROE that would be consistent with that principle, right?
That is correct, and we established it. You may not agree with the result, but using your numbers, it was 9.36%.
We don't agree on that. I think we were using a different time frame, but that's okay. Last thing I want to talk about is you have a chart in both your direct and surrebuttal testimonies where you report your model results.
I have a couple charts that do that, I think, but go ahead.
You have one in your direct and one in your rebuttal, and
Yes.
if you want to, I'd like to take you there if you can. Just want to point out a couple of things. So in your surrebuttal testimony, sir, the chart that I'm referring to is on page 3, and it's table 1.
Yes, that's the chart from the direct testimony, which is before the updates.
Correct. And then you have an update one further down in the testimony, if you look, that is table 5. Do you see that?
Not yet. Now I do. Yes,
Okay.
on page 10.
What I want to point out is, as I understand your surrebuttal testimony, you did not redo your DCF model at all as part of your surrebuttal. Is that correct? You didn't redo the calculations at that point?
Right, they were up to date with the value line data. There would be no real changes to DCF or the internal rate, or the two-stage DCF, so I
Right.
did not update those.
So those first two wouldn't have changed, those first two boxes, right?
Yes, sir.
And then the CAP-M, ECAP-M, and equity bond risk premium, you did update those models, and those models all showed increased numbers, correct?
Yes, very small for CAP-M and ECAP-M, a little larger for the risk premium because I used the October yield, spot yield.
Right. And so despite the fact that all three of those went up, including the equity bond risk premium going up a decent amount, that didn't change your recommendation here. You stayed at the same ROE recommendation you did in your direct, correct?
Yes, just like Ms. Nelson stated her same recommendation.
Thank you. That's all I have.
Thank you, sir.
Thank you, Mr. Saban. Mr. Moore, any redirect?
Just a couple questions. Mr. Lawton, can you turn to page 9 of your SIR rebuttal?
Just give me a moment. I'm there, sir.
Now, there's been some discussion about whether you use a spot yield in your testimony. Could you please read the last sentence of the first paragraph?
Yes, sir. The resulting risk premium is combined with the updated 30-year U.S. Treasury yields through September 30th, 2022, the 30-year U.S. Treasury recent three-month average yield, and the October 10th, 2022 spot yield of 3.8% to determine the range of risk premium estimates of equity costs.
Thank you. Now, there's been a lot of talk about recent events affecting your analysis. Does your analysis take into account these recent events, and if so, how?
It does indeed. As I said at the start in my presentation to the commissioners when I started, everybody updated the data to current data. As I point out in that page you just asked me to read, it's through October 10th. It's taken into account updated inflation and impacts on Treasury yields. So I think all witnesses in this case did that. I did that. There should be no dispute. It's what the facts are.
Thank you. I have no further questions.
Thank you. Ms. Schmidt, any recross?
None, thank you.
Major, Major Buchanan?
No, thank you.
Mr. Russell?
No questions, thank you.
Thank you, Mr. Saban.
No questions.
Okay, Commissioner Allen?
No questions, thank you.
Thank you. Commissioner Clark?
Mr. Lawton, you testified in the last case as well, am I correct?
Yes, sir. Yes, Commissioner.
Mr. Saban's questions about our order in that case and how it might relate to current facts and your modeling led me to wonder what your recommendation was to us in the last case. I can't remember what it was. Do you happen to recall?
It was probably approximately 9 to 9.1%, if my recollection is correct. I think it was there, and because part of that case also was included the settlement of the parties on capital structure to move that equity ratio up, and that has an impact. Every witness in this case will tell you that equity ratio, if it's increased, reduces risk, and therefore a lower return should be authorized. And I think you commissioners stated that in your last order in the rate case.
That's my only question. Thank you.
Thank you, Commissioner.
Thank you. We seem to have some history of rate cases from Dominion Energy Utah about every 3 years.
Yes, sir.
You've been involved in, I think, more than one, the last one and I think the one before too.
Yes, sir.
When we look at the risk-free rate for the portion of this, would the 3-year Treasury yield be more appropriate than the 30-year, or is there a logical hole in that?
Well, I don't know that it's a logical whole, but most analysts would look as the longer-term Treasury yield as a better estimate of the risk-free rate. It used to be historically, a lot of times people looked at the 20-year Treasury bill and Treasury yield, and most have now gone to pretty much the 30-year Treasury yield as the good estimate for the risk-free rate.
Okay, then changing topics, just to follow up on Commissioner Clark's question a little bit.
Yes, sir.
The authorized return on equity we adjudicated in February 2020.
Yes.
There's maybe a maximum of 3 people in this room who think that was the right decision. But putting
I
that,
hope you're not including me there.
putting that aside, if you were to say in total, all the economic indicators that you think reflect on ROE, where would you say they are today compared to February 2020?
We're talking early February 2020.
Sure, yes, yes.
And the economic indicators, obviously today are worse, because right after February 2020, as you know, we had the shutdown, we had the grand recession, a great recession that really hit the economy hard because of the shutdown, and then all the spending to get back, and now we're like most countries around Europe, we have high inflation, and it's impacting interest rates. You see that every day. And so so that's where we are. The question for you, commissioners, is in your decision-making process, is where are we going to end up? And it's likely, I think most analysts, for when these rates are in effect, because that's what you're looking at. And I think we're going to be in a recessionary time period for a bit. All the estimates seem to lead us there. And that's when indicators turn around for the better after you take a hit. And that seems to be what's happening not only in the real estate market, but with the push, through the push in interest rates, and a lot of business earnings you're seeing start to slow down and come down. Those are the things that are going to slow the economy down. And so that's the period these rates will be in effect. That's what is likely to happen.
Thank you, and thank you for your testimony this afternoon.
Thank you, commissioners. Have a great day, and thank you for welcoming me back.
So in terms of how we've agreed to go forward on witnesses, is there an agreement for where we go next? Should we go to Mr. Coleman before we start going to witnesses on other issues, or was there some other understanding?
I think it was to Coleman next. Yeah, yep.
If you'd rather we
Okay.
go to Mr. Mendenhall, that is fine with us, too, but
No, unless there's other time considerations. Obviously, Mr. Mendenhall has some ROE testimony too, but I think considering where we've been today, it probably makes sense to go to Mr. Coleman next if there's no objection from anyone.
sounds good.
Are we through the travel restrictions, by the way? Do we still have anyone else that needs to get their testimony done before a flight?
Okay,
Okay, if anyone finds out that's not the case, just let us know before we wrap up today, so we'll know to
if they need them,
deal with that tomorrow.
thank you.
Good afternoon, Mr. Coleman.
Hello.
Do you swear to tell the truth?
Yes.
Thank you.
Good afternoon, Mr. Coleman.
Good afternoon.
Could you please state and spell your full name for the record?
My name's Casey J. Coleman, C-A-S-E-Y-J, and then C-O-L-E-M-A-N.
By whom are you employed, and what is your title?
I'm employed by the Division of Public Utilities, and my title is Utility Technical Consultant.
For the record, what is your business address?
My business address is 160 East, 300 South, Salt Lake City, Utah, 84114. Subject check. It's been a long day.
Indeed.
I couldn't resist.
In conjunction with your employment by the division, have you participated on behalf of the division in this docket?
Yes,
Did that participation include participating in the preparation and filing of what has been pre-marked and filed as DPU Exhibit 2.0 Direct with Exhibits 2.01 through 2.07 Direct and Exhibit 2.0 SR with its accompanying exhibits, 2.01 SR through 2.08 SR?
yes,
Do you have any changes or corrections to those pre-filed exhibits?
yes. If you look at DPU 2.05, which was our CAPM analysis in the direct testimony, there's two tables that are there. One was using the equity risk premium from Kroll, and then the table below it is using the equity risk premium from Dr. Damberdren. And in there, I believe it shows 2.87 for the risk-free rate, and that should change to 3.5%, which is the normalized risk-free rate that we had used for Kroll. So that would be, I'm not sure in the table, but it's number 1, I believe. And that will impact the final ROE calculations. And I can read those off if the commissioners and others would like me to read that. This was provided to all parties as a reply to a data request. Dominion Energy did ask this in a data request, and we updated it, but I don't believe the commissioners would have that. So I can give you those updated numbers if you would like.
Seems like it would be good for the record to have
Okay.
those stated.
So in column 4, when you're looking at average beta for all analysts, the updated number, so column 1 will all be 3.5%. In there, just to make sure that makes sense. The beta coefficients and the equity risk premium doesn't change, but then the ROE calculations will go to 6.51% for the average for all betas. The average value line beta will go to 7.92. The average Zacks beta will go to 5.79, and the average Yahoo Finance would be 5.82%. And the mean of all of those will be 6.51%.
With those corrections, if I were to ask you the same questions that are present in your pre-filed testimony, would your answers today be the same as those contained in your pre-filed testimony?
Yes,
With that, the division would like to move for the admission of DPU Exhibit 2.0 Direct with its exhibits 2.01 through 2.07 Direct and Exhibit 2.0 SR for surrebuttal with accompanying exhibits 2.01 SR and 2.08 SR.
Please indicate if anyone objects to that motion. I'm not seeing any objections, so the motion is granted.
Thank you. Mr. Coleman, have you prepared a summary to present today?
I have.
Please proceed.
Thank you, Chair LeVar, Commissioner Clark, and Commissioner Allen for the opportunity to discuss my position and analysis regarding the cost of capital for Dominion Energy Utah. As noted in the testimony in this docket, we find ourselves in a changing economy with varied expectations for capital markets moving forward. My work in this case is focused on balancing long-term financial models with other market data and judgment to ascertain a reasonable cost of capital that leads to just and reasonable rates. In my testimony, I've completed and included the calculations for the various models and recommended an appropriate cost of equity for Dominion Energy Utah. The Division of Public Utilities recommendation is based on an evaluation using the discounted cash flow model, the capital asset pricing model, and risk premium models along with experience judgment on other factors that must be considered in Dominion Energy Utah's cost of capital recommendation. Based on my analysis, the appropriate cost of equity for Dominion Energy Utah is 9.3%, with an overall weighted average cost of capital of 6.82%. My recommended return on equity and its cost of capital estimate is within the Division of Public Utilities calculated range of 8.93% to 9.73%. My testimony evaluated risks such as interest rate risk, business risk, regulatory risk, financial risk, and liquidity risk. I find Dominion Energy Utah is less risky than the broader market and similarly or less risky than regulated natural gas utilities. The average allowed return on equity for 2022 is 9.42%. My recommendation of 9.3% return on equity fits the Hope and Bluefield standards of capital attraction, comparable earnings, and financial integrity. Company critiques of my data and models are incorrect. The company has argued because of a number of economic factors and increased risks to Dominion Energy Utah to adequately compensate investors for a return on equity of 10.3% is just and reasonable. The company used many of the same financial models that the Division of Public Utility used to analyze the financial markets to support its recommendation of 10.3%. The Commission should put little weight on the financial calculations of the company because of its flawed analysis using the discounted cash flow model, the capital asset pricing model, and risk premium models. The record before the Commission does not support a 10.3% cost of equity, and the Commission should set the appropriate cost of equity for Dominion Energy Utah at 9.3% with an overall weighted average cost of capital of 6.82%.
Thank you. Mr. Coleman is now available for cross-examination questions and questions from the commission.
Thank you, Mr. Moore. Do you have any questions for Mr. Coleman?
No questions, thank you.
Thank you. Major Buchanan?
No questions, thank you.
Thank you, Mr. Russell.
No questions, thank you.
Thank you. Mr. Saban?
Yes, thank you. Good afternoon, Mr. Coleman.
Good afternoon.
I want to just start with a couple of what I think are fairly basic things we hopefully can agree upon. When we are attempting to establish an ROE for the company, the law and cases that have developed over the years tell us that what we're looking at, I think, if you agree with me, is we're trying to quantify the risk that an investor would be taking if kind of put in this situation and investing. Do you agree with that?
I don't know the legal analysis, but my testimony did talk about the risks and the opportunity costs of an investor that would be, that they would look at to determine the appropriate investment for them.
Yeah, so this might help. I think it's in your rebuttal testimony at 13. If you want to go there with me, I can just.
Page 13?
Give me 1 second. I'm sorry, I'll get there. Okay, yes, at page 13, and I'll just point you to your statement that I'm asking. It starts on line 312, Mr. Coleman. And you say there, when determining the cost of capital and the appropriate return on equity for a utility.
Sorry, I'm not there yet.
Oh, I apologize. Page 13, line 312.
Okay. Okay.
Would you just go ahead and read into the record lines 312 and 313?
When determining the cost of capital and the appropriate return on equity for a utility, parties and the Commission are attempting to quantify the risk investors are taking.
So if I understand what you're saying, when you're doing your assessment, you're trying to look at all of these factors to determine what the appropriate return would be for an investor where the investor brought in asked to invest here, what would that investor pay for, what would they expect for a return? Is that a fair statement?
I think what it talks about is the risks of different investors, and there's a variety of different risks that would be analyzed by an investor to determine if it's appropriate for them to invest their capital with the company or not.
Exactly, right. They're looking at, if we take all the factors today and we took a representative investor, knowing all the things you and I know, and looking at all the other options in the market, we're trying to set a rate at an ROE at a point where that investor would be willing to invest here.
Yes, but you need to you need to clarify which risks you're talking about, because I said risks, but there are different risks that are going to be appropriate there. So I would need to know what risks you're talking about.
I'm just saying all the risks that an investor would take into account.
I believe there's 5 risks that an investor will take into account, which I talk about in my testimony.
You do. So with those being defined that way, do you agree with that statement?
If you're saying the risks that I'm talking about there are those 5 that I put in my testimony, then I would say those are probably the risks that most rational investors would look at.
Okay, thank you. And you would agree with me, given those risks, that the return we're talking about is the return that investor would expect for taking those 5 risks?
Comparable to companies with the same level of risk. So it's not just risk. You have to look at comparable companies and what they're getting as far as their return, because an investor is trying to look at what risk is going to compensate them fairly for the risk that they're taking within that company. So, for example, if I'm investing in Tesla, I may expect a different rate of return than I am in a utility, because the risk of that investment is going to be different.
Right, and when we're trying to set an ROE, we're trying to establish a return that would be sufficient to cause the investor to want to invest in this specific utility, right?
Considering the risk profile, yes.
Yeah, and if you look, just go to the next page, on this page 14 of your testimony, you cite Dr. Morin in New Regulatory Finance, and you include a quote, and that's what you're saying there, isn't it? That's what we're doing?
According to investors and what Dr. Morin says there is there's going to be 5 different elements of risk that you would analyze to determine the appropriate equity risk premium, or what needs to be compensated for an investor for their opportunity cost of investing somewhere else.
Okay. So I think we're in agreement there. Now I'd like you to go to page 4 of your rebuttal testimony. And there you're responding to Ms. Nelson, and you're talking about the commission's order in the last rate case. And we're going to start on page 4. It's the bottom half of that page. And what I'd like to do is just read a couple of paragraphs and then ask you a couple of questions about that. So tell me, sir, when you get there.
Do you have a line number?
Yeah, we're going to start on line 95.
Okay.
Okay, and what you say there is, and I should say, you're responding to a point here where you're addressing Ms. Nelson and explaining in response what the commission did in the last rate case. At least that's how I understand your rebuttal testimony. Is that what you're attempting to do here?
Yes, I was trying to explain past commission practices and what had been done historically.
Right. So what you say here is you say DEU filed a rate case in 2019 requesting an increase in rates and revenues. Many factors were considered by the commission, and ultimately a rate decrease of 30 basis points was ordered for DEU. This reduced the cost of equity to its current level of 9.5%. And then you go on to say, in its order, the commission discussed its, quote, starting point for this evaluation is our most recently approved ROE for DEU, close quote. Would you agree that that's commission practice in the state of Utah, is that they begin by looking at what the past approved ROE is for the particular utility?
I think the commissioners can decide what the past appropriate is. I just quoted what they had said in their last order, so I'm not going to tell them what they've done or what they haven't done.
Is that your understanding of their practice?
For that last order, I'm not going to say what the history has been forever, but saying from that last order, that's what they did say.
Okay. Then you go on to say the commission continued its evaluation by, quote, considering the extent to which financial conditions have changed since that decision and the impacts those change conditions should have on DEU's authorized ROE, close quote. Again, that, you're describing what the commission said in its order. Do you agree that that's what the commission did in the last rate case?
Yeah, that's what they quoted in there, yes.
Okay. So now I want to just go to the next page here. You say, in that order, the commission recognized that some factors and conditions would positively impact the authorized ROE, and some would negatively impact the ROE. This point is illustrated by the following comment made by the commission, and then you include a quote where you say, and you're quoting the commission here, issues that can be viewed as credit negative for DEU, potentially leading to an increase in its authorized ROE, include federal tax reform enacted in late 2017 and the Federal Reserve's cessation of injecting capital into the market. Conversely, declining U.S. Treasury rates since February of 2014 could indicate a need to reduce DEU's authorized ROE. And then you quote them, they talk about a couple of the recovery mechanisms that they take into account in their order. So what I want to know is, do you agree that the commission in setting ROE should consider the market conditions and let's just start there, should consider the market conditions as they have changed from the prior rate case to the present one?
When you look at the 5 elements that Dr. Moran talked about as far as what should be evaluated by investors and the financial aspect of it, none of those 5 talk about market risk.
So are you suggesting the commission got it wrong when they looked at market conditions in the last rate case?
I'm not suggesting the commission did anything. My testimony talks about the 5 things that investors are going to look at, which are those 5 elements, and none of those 5 talk about market risk. Now, having said that, part of the reason why I would suggest that you don't look at market risk, or why it's not as important, is market risk is going to apply to every single stock within the investing community. So inflation is going to impact, in different ways, a company differently. How it impacts Dominion Energy Utah, which is what I talked about, and it's in my direct testimony, could also be different than how it's going to impact a grocer, say like Kroger or Walmart or something like that as well. And so the market risk is something that would be factored, but generally from investors, that's already going to be captured in the models and in what they're assessing, because those are known. And what they're trying to do is to say, how is this specific company going to be different than all the others when I'm creating my portfolio to minimize that risk for me? And so am I saying the commission got it wrong? They can do what they want to, but I'm saying with the financial information and what's out there, primarily you're looking at 5 of those risks, one of which is not the market risk, because that's applicable to all of the stocks within the market.
So I appreciate the clarification. So let me ask it this way. Do you believe that in what you have done, have you taken into account the market risk, the market changes that have occurred in the last, say, 12 months in coming up with your recommended ROE?
Yes.
Okay, and you would say you've included them in your modeling then?
Yes.
And they've not been factored in any other way?
I'm not sure what you're trying to get at with that question. Factored in any other way is way too broad.
Well, I think you were just saying that that's where it's incorporated for you, is in the modeling only. Is that right?
No, I'm saying that investors are looking at 5 different risks, but you're asking me if those considerations as far as the market was part of what was in my financial models. The answer to that is because I'm looking at an equity risk premium from Kroll that looks at a variety of different things. That's part of what's included in their equity risk premium.
And all I'm asking is, in your other factors, your 5 factors, if you take out the modeling, you're not including any market risk anywhere else in what you're doing. Do I understand you correctly?
Are you saying in my return on equity estimates that I'm making to the commission? Are you saying that I'm not taking any of the marketing? I don't understand. I'm not trying to be difficult, but I don't understand what I'm doing. There's a lot of ways that we've discussed things here. What I'm doing is very general, and I don't know how to answer that specifically enough to provide value to the commission. So or to the parties in this docket.
That's fine. We'll move on. Going back to your surrebuttal testimony, line 115 to 119, you say, From these statements, it is obvious that the commission weighed current market conditions, analyzed whether these conditions would be either negative or positive for DEU's ROE, and ultimately decided to lower DEU's ROE. The commission simply stated, quote, "As we consider the totality of these high-level issues, we find that a reduction in DEU's ROE is appropriate." And then to conclude, you say on line 121, "The commission has shown that as market conditions warrant, it will decrease or, I think you mean increase a utility's ROE." So I just want to make sure I'm clear on what, I think I understand what you're doing. Do you have any qualm with the way the commission comes up with its ROE? Are you saying that it would be inappropriate for them to consider the changes in the market conditions to move the ROE up and down as those conditions may warrant?
So I think if you look back at line 118, the important element there and the word that they talk about there, and again, we're quoting the commission, so I'm a little uncomfortable quoting the commission with them sitting here, but it does talk about the totality of these high-level issues. It's not talking specifically just about the market risk. Totality means that they're looking at a variety of different elements. And I don't believe the commission has directly said, we weight market factors by 0.25%, and then we weight the other factors by 0.25%. When they make their determination, which is also what we did with the division, is we look at the totality of the situation. What's the market situation? Because that's going to impact our ROE determination. To say that it doesn't have any impact would be naive, right? But having said that, you look at everything that's coming together to come up with a recommendation that's going to adequately compensate Dominion Energy for the risk. Sorry, let me say that differently. It's going to adequately compensate investors in Dominion Energy for the risk that their risk profile that's going to be comparable to all of the other utilities or all the other investments that are available in the market for investors, so that they can attract that capital and be able to get what they perceive to be fair value for their money and their investment.
I understand. Do you agree that it would be appropriate for the commission, as market conditions warrant, to decrease or increase the ROE based upon whatever market conditions they believe should move the ROE up or down? Do you believe that's appropriate?
Again, I believe the commission can do what they want to, and I'm not going to say what the commission should or shouldn't do.
I'm not asking what they should do. I'm asking if you agree that that's appropriate.
Okay. Sorry for this slight deviation. Outside of my working as a division of public utility employee, I am an umpire in softball. And when I umpire, there's one opinion that matters, mine. The coach can tell me something or someone else can tell me something, but ultimately my opinion is the only one that matters as an umpire. What I feel the commission should or shouldn't do, their opinion is what matters.
I agree with that, Mr. Coleman. I appreciate that. I'm trying to understand whether you think it's appropriate to consider the changing market conditions or not in establishing an ROE. That's all. I just want to know what you think.
I already told you in my testimony that there are 5 elements that we look at with that as well. And that's what I said would be the factors that you would look at for the risk element of that. I don't know how else you want me to say that. I've answered that. And that's what I believe are the elements with that as well. If the commission looks at something different, that's their prerogative. That's what they have the ability to do.
Okay. I'll let that stand, however people want to take that. I'd like to talk about some of those market factors because, at least as I understand your quoting of the commission's decision, these factors do appear to matter. So I want to cover just a couple of these factors again, and I don't want to read through everything I did with Mr. Lawton, but we can do it that way if you want. I'm just going to show you a few things and ask you a few questions to see if you agree that these circumstances have in fact changed. Okay, so first off, I'm going to ask Mr. Mendenhall to take around one cross exhibit. This will be marked as DEU cross exhibit number 8. Okay. So do you see that, that document? This is a Bloomberg article, Mr. Coleman. I'll just reference that, and it's dated, I think it's, I don't see the date all of a sudden. Oh, there it is, October 14th, 2022.
Okay.
Do you see that?
Yes.
This article is talking about the Federal Reserve's decision to cease injecting capital into the market, bringing about reducing the liquidity that exists in the market. And so if you look, for example, on the first page down at the second full paragraph, second sentence says, liquidity is quickly evaporating, volatility is soaring. Once unthinkable, even demand at the government's debt auctions is becoming a concern. Conditions are so worrisome that Treasury Secretary Janet Yellen took the unusual step Wednesday of expressing concern about a potential breakdown in trading, saying after a speech in Washington that her department is, quote, worried about a loss of adequate liquidity in the $23.7 trillion market for U.S. securities. Make no mistake, if the Treasury market seizes up, the global economy and financial system will have much bigger problems than elevated inflation. So, Mr. Coleman, do you have any reason to disagree that in the current economy, liquidity is evaporating, as this article is saying? It's becoming very tight. There's not a lot of liquidity in the current market.
So if you look at this, looking at the very top, it shows that it's an opinion from one person, Robert Burgess. I don't know who Robert Burgess is. So this is coming from Bloomberg, but it's just his opinion. And so he's talking about the way that he sees liquidity in the market and how that's going to impact that as well.
I'm asking you, do you have any reason to disagree with Mr. Burgess's view that liquidity is quickly evaporating in the market?
Liquidity in the treasuries?
Yes.
That's what he says. That's what his opinion is.
I understand that's his opinion. I'm asking you, Mr. Coleman, do you disagree with that view?
I don't know in my testimony where I talked about treasuries in my rebuttal or surrebuttal testimony.
I didn't say you did. I'm asking you whether you disagree with this view.
In that case, I would object. I would, on the basis that it is beyond the scope of his pre-file testimony.
Yeah, unless you can identify where it's in his testimony.
He's quoting you, the royal you, to say that Federal Reserve cessation of injecting capital into the market is a reason why you might increase ROE. That's what this is about, is getting him to acknowledge that that is what's going on in the market. So I think it's directly relevant to what he's relying on you for.
Okay.
I would-
So, can I ask Mr. Saban one more question? To better understand Ms. Schmidt's objection, when you were reading from this article, I didn't find the paragraph you were reading from, so that would
I
help me.
apologize. It's the second full paragraph at the bottom, starting with
Of the first page?
Of the first page, starting with the word liquidity. It's right, the top, the first line.
Oh, there we go.
It's that through the end of the paragraph, Mr. Chair.
Okay, Ms. Schmidt, did you want to add something to your objection?
I would add that there are many things also mentioned in the quoted paragraph that Mr. Saban is not addressing.
I believe,
So-
go ahead.
Well, if you want to add anything, I'm just about prepared to rule on the objection.
Go ahead.
I'm not convinced that Mr. Coleman's quotation of a paragraph from our order, that the paragraph includes capital injection in the market by the Federal Reserve. He doesn't then, in his own words, go into that issue any further. So I think I'm not going to conclude that he opened the door in his testimony to questions about market liquidity. So I'm going to sustain the objection.
All right. I will move to admit the cross exhibit 8 into the record.
Okay, is there any objection to that motion?
Yes, I would object as to its relevance, given your ruling on the paragraph quoted and the question related to that.
Mr. Chairman, I'm sorry, but it's obvious to me he's talking about market conditions throughout much of his surrebuttal at least, if not his direct. These are market conditions that are relevant to the question that is before you, as evidenced by your prior order. So I don't know how we can say these are not relevant. And he has in here a summary of what market conditions this commission considered. This is one of those market conditions contained in the quote he's talking about. I don't know how this can't be either relevant and directly on point to what we're looking at here.
I'm going to think out loud for a moment. Considering also that this is an opinion piece and not an economic analysis, I think I'm agreeing with the objection. As an opinion piece, it also implicates a little bit whether the author should be subjected to questions on it rather than more of a objective financial analysis like we've been seeing from the S&P articles. So I'm going to sustain the objection.
All right. You do talk about volatility in your testimony, do you not, Mr. Coleman?
I do talk about the VIX, yes.
Yeah. And you would agree with me, would you not, that since 2020, the VIX has gone up to its highest point since COVID-19. Isn't that right?
Yes, and also in my testimony, I talk about, and Mr. Lawton brought this up, I'm not sure how that translates to utilities and the value of just the fact that the overall market is more volatile.
I understand your position. My question was just simply, it has gone up to its highest point since COVID, correct?
I don't know if it's the highest point since COVID.
Well, let's look at Cross Exhibit 5. It's in front of you in the pile of exhibits, hopefully.
I might have moved them, sorry.
May I approach the witness with that exhibit?
Sure, thank you. Oh, sorry, I meant, if she was going to give it to him. I didn't mean to take that out of your, I
it's all
thought she
good.
was going to give him the copy, that's fine. I don't object.
Neither do I.
Okay. Do you, Mr. Coleman, do you not have any of the cross exhibits that were left there?
I probably moved them.
It'd probably be good to get the whole stack, actually.
So I think, and then I think it's that one.
Okay,
Okay. You have Cross Exhibit 5 in front of you?
yes.
Do you see on the first page that U.S. government bond volatility at early pandemic levels? That's the title that's above the chart.
Okay,
And do you see the chart, if you look at March of 2020 and you look at the volatility today, they're roughly equal?
remind me what your question was?
Do you disagree that the volatility in the market is at the same level, or roughly the same level as it was during the pandemic?
I agree with that. I think you asked me if it was higher before, and that's not, what you characterize now is correct. I think you asked me if it was higher before than the pandemic.
If I ask it that way, I didn't mean to. Would you also agree that if we look for February of 2020, that the VIX is much higher than during the last rate case?
Again, yes, but I want to clarify again what the VIX talks about. This is actually talking about the S&P 500, but it's also options on the S&P 500 for a short-term time period. So there is volatility, and that's what this is showing, but it's options on the S&P 500 that's being traded. And most of us in the financial market know that if you're talking about an option, it's going to be way more volatile than the actual stock itself because of the way that leverage happens and the way that those options work. And so I know that Ms. Nelson uses this and it's put out there, but again, in my testimony I talk about this. I don't know how this is valuable to a regulated utility because it's dealing with the options of the S&P 500. And so yes, I'll agree with what you're saying, but I don't understand the relevance or the value of this information to a regulated utility.
Isn't Dominion Incorporated in the S&P 500?
We're not dealing with Dominion Incorporated, we're dealing with Dominion Energy Utah.
I understand, but there are the utility stocks there are utility stocks in the S&P 500.
The commission is setting rates for Dominion Energy Utah, which is going to be specific for the ratepayers of Utah and for what that company is there, not for Dominion Energy Incorporated.
Okay. If you'll turn the page,
And again, that gets back to what I was saying. You're talking about the stock. This is talking about options and the options in the market, which is vastly different than the stock itself. And the volatility of an option is going to be greater than the stock itself.
are you aware of whether there are utility options at issue in this?
Sure, but that's not what we're talking about. You're asking about the volatility and the value of the volatility, and I'm saying when you look at an option, that's vastly different than looking at a regular stock.
Okay.
And so I don't understand the value of this index.
Let's go to page 2. On page 2, you'll see the same chart I showed to Mr. Lawton. Do you have any reason to disagree that Treasury yields have, quote, soared in 2022, up, for some of them, up as high as 300 basis points?
Again, I don't know where I talked about Treasury yields in my,
In setting your risk-free rate, you rely on the Treasury yields.
no, I rely on the normalized rate from Kroll.
Right, but that comes from the Treasury yields.
I relied on the normalized rate for Kroll.
I think I agree that the treasury yields are relevant to that, so I think it's a fair question.
Okay. Would you want to repeat your question?
Yes, do you agree or have any reason to disagree that in 2022, Treasury yields are substantially higher than they were at the beginning of than they were at the beginning of 2022?
Will you clarify what you mean by substantially higher?
300 basis points is what this article talks about. For some of them, it's for some years.
I can agree to 300 basis points. That's what the article shows.
Okay, thank you. The article also talks about that we're going through a period of the highest inflation in 40 years. Do you have any reason to disagree that that's going on?
That's what the article says, and we've talked about inflation in this and
Okay.
also in my direct testimony, so I would say that that's accurate, that statement's characterizes what's going on in the market.
Okay, thank you. Now, you mentioned your Kroll data.
Correct.
Can you just briefly explain how you came up with your risk-free rate using the Kroll data? Would you just walk us through what you did?
Kroll puts out their recommendation of what they believe the risk-free rate would be. It's going to be dependent on what's happening in the market. So they suggest that the normalized risk-free rate would be 3.50%, which is what I used in my models. If the spot rate is higher than 3.5%, then their recommendation is to use the spot rate according to when you're doing the analysis. So I used, because at the time that I did the analysis, the 3.5% normalized risk-free rate from Kroll.
Great, thank you very much. So in your stack, would you find DEU cross exhibit number 7?
You probably have to give me a little more direction than that, because I don't know that they're written on
It will
here.
be the selected interest rates, the H.15. Yes, that document.
Well, it was right on top. How fortunate is that?
We're all happy that that's easy to find.
Well, let me fumble for a second. Let's see if I've got it.
My understanding is that if we look down this document, down about halfway, you'll see the Treasury maturities, and then it will go from 1 month all the way to 30-year. Do you see that?
Yes,
And the one you use, I think, is the 20-year, correct?
that's the one that Kroll suggests to use.
Yeah,
Yes.
and you've used that for your risk-free calculation, correct?
I've used Kroll's recommended
20-year.
risk-free rate.
But it's pegged on the 20-year, right?
I would have to look at the information, but subject to check, I believe that's accurate.
Well, let's go there. I think it's in your DPU Exhibit 2.04S. Would you pull out DPU Exhibit 2.04S?
Two point oh four S?
That's what I show, yes.
Let me-
It's, the top of it says Kroll in letters on the right.
Give me a second to get there.
SR, I guess it is. SR, not S.
Two point oh four.
SR.
Yes. So I'm looking at basically Kroll's risk-free rates over what they've recommended over a period of time.
You see in the middle of your document, it says the
Yeah.
20-year U.S. Treasury yield. So if we look on Exhibit 7, the 20-year Treasury yield is 4.25% as of October 14th, 2022, right? If you look on the right-hand
Yes,
column.
yeah, yes.
Okay. So, and you used, I think you just referenced, you used 3.5% because that's what Kroll has there in the column R. It's called, the top of the column is R with a little F below it, right?
Yeah, that's how they're indicating what their risk-free rate should be, yes.
Yeah, and you used, I take it you used that top line that is in red, is that right?
Yes, because at the time, when we were doing the analysis, the risk-free rate was below 3.5%, and so we had used the normalized rate, risk-free rate of 3.50% as recommended by Kroll.
Right. Now, that's true for both your surrebuttal and your direct. You didn't change that. You used the 3.5 for both, isn't that right?
In the surrebuttal, we basically had indicated that there could be some minor adjustments, but we didn't make any major adjustments in rebuttal to surrebuttal as far as our financial calculations. So if that was what you were asking, the answer is yes.
More specifically, all I mean is you were using the same 3.5 in your direct and your surrebuttal, right? You didn't change that number.
Where in my surrebuttal would you want me to change that number?
I'm saying that you didn't, in your surrebuttal, update to use a different number than 3.5.
Correct, because in my surrebuttal, we didn't redo any of the analysis because we felt that information was still going to give us a reasonable allowed rate of return, which is what our recommendation was of 9.3%.
Right. Now, at the bottom of that exhibit that we're looking at, the DPU 2.04 SR, do you see the red language there at the bottom of the page?
Yeah.
Would you please read that quote?
We recommend using the spot 20-year U.S. Treasury yield as the proxy for the risk-free rate if the prevailing yield as of the valuation date is higher than our recommended U.S. normalized risk-free rate of 3.5%. This guidance is effective when developing U.S.-denominated discount rates as of June 16th, 2022 and thereafter.
Now, it's true, is it not, that after your direct testimony, the yield went above 3.5% on the 20-year Treasury?
Possibly, yes. I didn't look at every individual spot rate with that, but that is a possible characterization.
And you would agree today, or within the last several, on that document we're looking at, it shows October 7th, 10th, 11th, 12th, and 13th, that in all of those instances, the spot was always above 4%.
Yeah,
Right.
and the important element of that as well is if you look at our CAPM model, which is where this is primarily used in a couple of different ones, our analysis of the CAPM model was returning, we talked about the average just with what I updated as 6.51%. And so our recommendation of 9.3% is still different than that recommendation. So even if I went and updated it to say 4% or something different, it's not going to vastly change our analysis with the CAPM. It will change our analysis with the CAPM, but it's not looking at the totality of all of the different elements going to change what our recommendation was to the commission. So yes, they have changed. Yes, our CAPM analysis and some of the other ones using a risk-free rate would most likely come up some, but at the end of the day, if you look at our recommendations and our analysis, it wouldn't change it to where we're going to be extremely different than what we had calculated, and it's not going to change our recommendation of the 9.3%.
You haven't run that calculation, it sounds like, is that right?
I could do it right now if you wanted me to.
I'm just asking. We'll
I
come to that
haven't,
in a
no,
second.
but I could. If that's something valuable for the commission, I'd be happy to do the analysis and calculation right now.
We may get there. Let me get through some questions first. What I'm trying to understand is, Kroll told you to use the higher number, and you were relying on Kroll data for your calculation of the risk-free rate. Despite that comment, you did not use the spot market number as of the date you filed your surrebuttal, right?
I would have to see what the spot market numbers are, because obviously we're trying to pick a point in time when we have to turn this information in. And so the risk-free rate was, I'd have to know the specific point as far as what it was on the date when we turned in the information to say if it was higher or lower. Today, is it higher? Yes. I'm not arguing that at all. But I'm also saying to the commission, if we did put those numbers in, and I'm happy to do it, I have my computer right here, I can put the numbers in and do that with today's numbers, if that is something that's going to be valuable to the commission to help them have a more accurate record. What I am saying, though, is sorry, I'll slow down, I apologize. What I am saying, though, that is if we do that analysis, it will increase our CAPM numbers somewhat, but it's not going to change significantly the overall analysis that we would recommend something different than 9.3. So on that day, it might have been different. It could have been 0.36 or something a little bit different, but it's not going to be a material enough calculation or change that would undermine our recommendation of the 9.3%.
And I'll just, I appreciate that answer. I'll just point out that your surrebuttal testimony was submitted, what date did you submit that? You submitted it on,
Let's see, the 13th, is that when surrebuttal was due?
October 13th. And so
Yeah.
if I look at the sheet we're looking at right here, on October 13th, it was 4.25%.
Okay. Having said October 13th, and I think the commission can respect this, and Dominion Energy Utah can also respect this, we have a review process that the division has to go through. And so just because we submitted something on October 13th, I have to have a cutoff date before that, so that other people, supervisors and others who are going to be looking at that are going to be able to review it and to say, yes, this looks fine. So we try to provide the most accurate and up-to-date information that we can. But was it as of October 13th? No, because that's when we had to file it, and I had to have a review with our internal staff and other people to make sure that that information was correct. So do you have what it was, say, like at the end of September?
I don't right in front of me,
So
but
I don't either, so I don't know how to answer that question.
I understand your position. I'm just
Okay.
pointing out, we have more current numbers than the 3.5, which was back in June, and Kroll is telling you to use the spot number.
Correct, and I've offered right now, if you would like to, I can do the calculation for you with today's number if you would like.
The problem I have is I don't have any way of looking at what you're doing and how you're running it through, and I don't have anything in paper to review and ask you about.
And
So,
if I may, I think that this question has been asked and answered and almost beaten to death. So perhaps
all right.
the commission may choose to ask DEU to move on.
I would be happy to review what you can do, and if I had the opportunity to ask you about it, I would be happy to do that. I just can't do it here I don't know what you're reviewing, so.
It's a pretty straightforward mathematical calculation with the CAPM, and all I would have to change is the risk-free rate in the table that I provided.
Yeah. And perhaps we can talk after and see if there's a way to get that submitted or we can review it and ask you about it.
Okay.
Would you go to your direct testimony, please? And this is on page 16 of your direct testimony.
Do you have a line number?
I do. We're going to start on line 380.
Starts with actions?
Will
Okay.
you read that down to line 385, please, into the record?
Okay. Actions from the Federal Reserve over the last few months have led to a tightening of monetary policy and an increase in the various Treasury rates.
So just stop there. I appreciate you stopping there. You did speak about a tightening of monetary policy then, didn't you?
I was basically quoting Ms. Nelson and how she was talking about the tightening of the monetary policy.
But it's referenced in your, my point is it's referenced in your direct testimony. You're talking about it, right?
In reply to what Ms. Nelson said,
Go on and read the next sentences.
as indicated in Ms. Nelson's testimony, the projected trend is for those rates to continue to increase from a 30-day average of 2.2% as of February 28, 2022 to 3.4% on average over the 5-year period from 2023 to 2027.
Okay. So first of all, I think you agree, do you not, that the trend right now is that Treasury rates are on an increasing, they're increasing.
Short term, there has been an increase in Treasury rates, yes.
Okay. Do you have any basis to believe that that will not continue through the test period?
Generally, we don't try to project where interest rates are going to go, and I talk about that in my testimony because projected interest rates have been very difficult. And I believe I bring out Chairman Powell, where he was just saying 2 to 3 years ago, there's no way we were going to be raising interest rates. I'm paraphrasing. Obviously, I can go to my direct testimony if you'd like the exact lines, but he was saying, we're not going to increase rates. There's no way that we're going to even consider increasing rates, but yet 2 years later, we are in this situation. So we don't try to project the rates because who knows where they're going to go. And it's pretty difficult to know for sure which way they're going to head. So I haven't projected the rates and haven't done that in any of my analysis.
My question is a different one, Mr.
Okay,
Coleman.
sorry about that. I apologize.
That's okay. My question was, do you have any reason or any evidence or any reason to believe that interest rates are not projected to continue to increase by people not in this room?
Projections have always been wrong and have overstated where they're going, so I don't have any reason to believe that people would project they're going up. I just don't know the validity or value of those projections when there are numerous articles out there, which we bring out again in our direct testimony, talking about the value of projections. And
Go ahead and finish if you need to finish.
it's okay.
I'm going to have Mr. Mendenhall hand around cross exhibit number 9. Mr. Coleman, I'm handing you what's been marked as DEU cross exhibit number 9. This is a Thursday, September 22nd, 2022 S&P Capital IQ article on the Fed. And it's talking about interest rates and where they're expected to be. You agree with me that the test period here is a forecasted test period through the end of 2023?
Yes.
Okay, so let's go down to the bottom of page 1, and it says there, since March, the Fed has boosted rates by 300 basis points, including 3 straight 75 basis point hikes, after leaving them near zero for roughly 2 years in response to the pandemic.
Sorry, where were you at?
Bottom of the first page, and then we're going over to the second page.
So the Fed's median 2020 forecast? Or is that page 2?
No, I was on page 1.
Okay, sorry. Now I got
That's
you.
okay. That's what I read the very bottom paragraph. Now I'm at the top of page 2. Top of page 2 says, Powell gave no indication during his press conference that central bank officials had any plans to slow down the push for higher rates, and said with the latest 75 basis point hike, the Fed may now be at the very lowest level of what may be considered restrictive monetary policy. And then there's a chart there. Do you see where it says the Fed now forecasts ending 2022 at 4.4% and 2023 at 4.6%?
I see that at the top, yes.
And that's coming from the Federal Reserve, right?
This is an S&P and Capital IQ, and I suspect that they're quoting the Federal Reserve accurately.
Okay.
I mean, this report isn't coming from the Federal Reserve, but I'll I won't protest too loudly.
Okay. So that's compiled as of, that data was compiled as of September 21st, 2022, right? And it represents the forecast you see under the chart. Forecast represents the median views of participants in the Federal Open Market Committee. You see that?
Page 3?
No, that was right under the chart we just looked at.
Okay.
Just wanting, you just said you weren't sure, you thought it may come there. I'm just pointing out who.
Federal
where it actually
Reserve
comes
Summary of
from.
Economic Projections. Okay, yes.
Okay. So back to my original question, that's what the Fed is estimating right now, is that interest rates will continue to rise until we get to 4.6% by the end of 2023.
And you're saying this is valuable because of the test period of 2023?
I'm just pointing out that it aligns with the test period of 2023, that we have an increasing interest rate environment, right?
Okay, can I talk about test periods for a second?
If you, go ahead.
So, I know that there's been a lot of discussion, and this was even in a cross exhibit that was provided. I don't know exactly which one, but looking at, actually, to give you context on this, Ms. Nelson talked about the historical numbers from the Regulatory Research Associates and how that's looking backwards. And and I think Chair LeVar, you asked this a little bit as far as, aren't there forward test projections that's going to be happening with that? I think if you look at the data on many of those cases, those commissioners are setting rates for forward test years. Now, there's some that are going to be set for past, some for current, and some for forward. And so the characterization that it's just going to be historical information, I believe, is not accurate, because they are going to be setting it, and there are some of them that look for 2023 and forward. And so Mr. Saban has asked me questions about the importance of a test year. Well, when looking at that information and trying to determine the importance of an average and how valuable it is, you have to also look at, which is what we've been saying the whole time, is you have to look at each individual company and the risk profile of a specific company to be able to determine what the appropriate rate of return is for investors. And so there is many of these companies there that had a projected test year and had rates that were higher than what the commission had done at the time. So sorry for a little bit of a deviation there, but you were talking about the test year and how it's important, and I think that that is an element that hadn't necessarily been brought out that the commission would want to consider when looking at that average for the rates of return. She talks about how it's historical, but I don't know that I necessarily agree with that characterization, because many of those are going to have historical test years just like we do, and they're trying to set it for 2023.
Thank you. All right, so back to your Kroll data. Now that we've talked about that and where the Fed thinks interest rates are going, you arrived using your risk-free rate and your the two portions. I'm blanking all of a sudden on the other portion. The equity risk premium.
If you're talking the CAPM model.
Yeah, you're in your CAPM model. You came to a 9% number, isn't that right? And how you got there is your premium was 5.5%, and your market,
No, the CAPM would never be at 9%.
I'm sorry, did I say nine? I meant.
It would be below 9%.
Help me understand. When you used the Kroll data of 3.5%, you put that, you added that to a 5.5%
Yes,
premium,
okay.
right?
Sorry, I thought you were talking two different things. In the CAPM model, when we did our analysis, it's not going to get at 9%. And the reason why is you're multiplying it by beta, but if you're looking at the total market return, the return of the entire market, then the Kroll data is at 9%.
Okay.
Sorry, and if that's what you're
That's
asking,
what I
then
was
I will
asking.
agree that it's at 9%.
And if you factored in the correct or the current, the spot market for the 20-year number we looked at, the 4.25%, that would move that figure from 9% up to 9.75%. That's right, isn't it?
Subject to check, yes.
Okay. Now, when you go back to your direct testimony at 17, we're going to go down from where we were reading, and we're just going to read one more section.
Can I, and I know I'm probably belaboring the point, but that's a total market amount for the CAPM. That's not for specific for a regulated utility. That's what the market premium would be for the entire market. And I think that's an important distinction that needs to be brought out there as well, is that we're talking about the entire market. And I think all of us here would agree that utilities are less risky than the entire market. So it would be 9.75 for the entire market, but what would apply to utilities, and specifically Dominion Energy Utah, would probably be less than that number because they are less risky.
We'll come back to that,
I
that
hope so.
position. We will. Go to bottom of page 17, if you will, on your direct testimony. Would you mind doing that?
Direct, okay?
Yeah. Line 407 is where I am.
Okay,
You say here, the increase in interest rates as a result of the tightening, I think it's supposed to say of monetary policy, can have an impact on utilities. The impact to the financial analysis done for these utilities will be minimal until the 20-year U.S. Treasury yield is above 3.5%. As shown in the information discussed by Ms. Nelson, the projected rates for 2023 to 2027 are not estimated to be above 3.5%. So the financial impact to DEU will be minimal, and the need for a higher cost of capital as a result of the tightening monetary policy is not supported. Now, a couple questions. You agree with me that you say when the impact doesn't result in the Treasury yield going above 3.5%, the impact of any increases will be minimal, right? That's what you're saying?
that's what the testimony said.
Right. The implication being that when it goes above 3.5%, it will be material. Isn't that true?
There will be an impact, I don't know, as far as material. Again, an important point to look at this as well, and it's been brought out numerous times. I won't know this, and so I'm going to go off of a reference, but I think the risk-free rate when we were looking at Dominion Energy Utah's case before was extremely low. And it was at 1% or something lower than that as well. And I don't remember Dominion Energy Utah arguing that that should be the risk-free rate that we use, and we should set the elements off of that as well. And so we're in an interesting economic period, which we have, our testimony has talked about that as well. So the spot rate is at 4.75%, but is that going to continue in 2023? There's some information that says that as well. And if the commission's comfortable with that, then they can look at that. But what we have not seen is that when the interest rates are extremely low, there hasn't been a reduction in the ROE that goes along with that reduction consistently with what the risk-free rate has been. It seems the utility commissions throughout the country has been much slower in bringing down that allowed rate of return than what has been happening in the market, and then moving it up much slower as well, which is partly what I think Mr. Lawton was trying to get to in his testimony as well. And so, yes, there's going to be an impact, but with the overall looking at every element that goes into a allowed rate of return, what is the impact of that going to be? And that's what the commission and all of us here are trying to determine is how to deal with that element of it.
Thank you. At least we can say that what you're saying here is that the impact will only be minimal when it's below the 3.5. When it goes above, we don't know exactly, but it's not going to be minimal.
The impact would be whatever the spot rate is when you decide to do that.
Exactly.
And having said that, there's two elements of that. When you look at Kroll's cost of capital, you use the spot rate and then whatever their equity risk premium is at the time. So there's a possibility that equity risk premium, and as I showed in my exhibit that we talked about before, that equity risk premium will also adjust to try to show what the total market return is and what's going to be fair for investors with that as well. So what happens a lot of times is that equity risk premium will come down as the bond and the risk-free rate goes up. And so you get to the point to where there's an element of it. So will there be an impact? Sure. But how will that affect the equity risk premium, the other elements of it? You have to look at both of those elements of it. And we don't know what the impact of the equity risk premium is going to be. We do have a spot point today. I'm not arguing that at all. But there are so many other elements that go into the cost of capital and aspects of that as well that the commission needs to consider.
And then just a couple other points on this quote. You agree that you at the time you did your direct, you said rates were not projected for 2023 to 2027 to be above 3.5%. And here we are just a couple months later, and we're way above that, right?
Which I think supports the reason why I'm not comfortable with projected rates, because it's hard to know for sure what's going to happen. So we have not, as a division, usually been comfortable with projected rates, because I could project them completely the other way and project them to be 3.6, and we could go back to the 1.4% or whatever. So we have consistently been uncomfortable with projected rates because it's hard to accurately get that number right.
And it's true, is it not? The reason you were making that argument was you were criticizing Ms. Nelson for her projected rates, right? That's why you had this quote in there, or this comment in there.
So if I understand correctly, Ms. Nelson's rate was projected from Blue Chip Financial?
I don't know where,
The
offhand, I don't know where
3.6%?
it came off. No, her rates are, the 30-year was, she projected at 2.2%, and the 30-year she projected at 3.13.
Okay.
So my point is, we're way beyond where she was projecting, we're way beyond where you were estimating at this point in the market, right?
Sure.
Okay. Just a couple more questions, and I think I'm done. As it relates to I want to come back to the five.
Can you point to me where the 3.21 was at as far as her projections and where she did those calculations?
Yeah, it comes from, let's see. Hers is her direct at 28.
And is she using Blue Chip Financial numbers?
Off the top of my head, I just don't know.
Okay.
That would be something we'd have to ask. I don't know. So I want to just go back to your 5 risk points, and I just want to ask a couple of questions on this. I asked Ms. Nelson earlier whether she, looking at 2020 and looking at 2022, whether she saw any evidence of significant regulatory risk changes between February of 2020 and now. And I've read your testimony, both your direct and surrebuttal, and all of the elements that the commission, certainly the commission looked at in 2020, are the same today. There is these recovery, there's these recovery mechanisms that are all the same. Would you agree with that? That we have the same recovery mechanisms today that we did in 2020?
I'll agree with that, but are you saying that's what makes up the regulatory risk?
I'm saying that's a component. Don't you agree that's a component?
Sure, that's part of the regulatory risk, yes.
So you would agree with me, I think, that hasn't really changed, right? From 2020 to 2022?
They haven't changed what the way that they're dealing with Dominion Energy Utah as far as the coupling and the infrastructure tracker and those elements, so that is accurate, yes.
Okay. And as I read your testimony, if I understand you correctly, you're saying that the regulatory risk has not gotten worse between 2020 and 2022. Is that accurate?
I think what my testimony says is that for you to accept the 10.3% recommendation of Dominion Energy Utah is that you have to be able to agree that the risks to Dominion Energy Utah is greater now than what would be compared to similar utilities or similar investments in the market today. And our position is that Dominion Energy Utah is less risky or the same risk as those utilities today.
So let me ask my question now and see if you can answer that one. From 2020 to now, do you believe there has been a change in the risk profile of DEU relative to those 2 timeframes?
Which risk profile?
The regulatory risk. Are they more or less risky today than they were then? Do you have an opinion on that view?
I believe that their regulatory risk is the same. It's not riskier. I believe it's either the same, or I would argue even less risky than a comparable set of companies.
Okay, that's all I need to know. Mr. Chair, I failed to move to admit cross exhibit 9, DEU cross exhibit 9 into evidence. I would move for that now.
That's the S&P Capital IQ rate hike pane?
Correct, yes.
If anyone objects to that motion, please indicate your objection. I'm not seeing any. Motion's granted.
That's all I have for now, thank you.
Okay, thank you. Ms. Schmidt, if you have more than 2 or 3 questions on recross, it might be good to end for the day and, I'm sorry, redirect, not recross. If you have just 1 or 2, we could do them now, but if you have more, it might be good to start first thing in the morning.
I have just one.
Okay, well, go ahead.
Mr. Coleman, isn't it often said that the thing that is most true about a forecast is that it will be wrong?
Yes.
Thank you. That was my only question.
Thank you. Any recross from that question?
Thankfully, no, we're good.
Okay, I think we will recess for the day, and we'll see everyone at 9 a.m. tomorrow. Thank you.
Have any questions, Commissioner?
Thank you.
You know what? Yes, it's been a long day. Recess is over. Commissioner Allen, do you have any questions for Mr. Coleman?
I do have one simple question, just to make sure that I understand the cross exhibits number 1 and 2, to make sure that we have the first one, which is, it's the S&P Global Report on past rate cases, and it goes back to 2020. And then the second one is much shorter, and it's just 2022, but the first one also includes 2022. And it's just maybe something you need to check, or maybe you remember what is going on here. But for 2022, the larger report has 9 cases. And for the 2022 in the short form, it includes 17. And it looks like it might be a date issue, and the only reason I'm asking is it's at the very bottom of the spreadsheet. So there's a possibility that some cases got truncated, or do you remember there were 2 separate reports?
There are 2 separate reports giving you much of the same information, but let me explain why I did that. So the first report, we were talking about settled versus litigated cases. And Mr. Mendenhall talked about the value of a settled case. And then Ms. Nelson provided a scatter graph that showed you a bunch of different rates that had been. She was trying to show basically a trend analysis in there. So in the first example that has the variety of pages, I just took the information that Ms. Nelson had provided, but gave to the commission, which she didn't show, which were settled and which were litigated. So all I did was take her information and just add that other column so that you would be able to see. And then in my direct testimony, sir rebuttal testimony, I talk about 126 of 184 of those cases that she graphed were settled. And so that's the reason why there's no calculations or anything on there, is it was just trying to add to the record what she had done.
That helps, thank you.
Okay. And the other one is just the calculation of what, we were trying to update what the most accurate and complete information as of the allowed rate of return was.
Great, thank you.
Yep.
Thank you, Commissioner Allen. I apologize for my brain freeze. Commissioner Clark, do you have any questions for Mr. Coleman?
No questions, thank you.
I don't either. Thank you for your testimony this afternoon.
Yep.
We'll see everyone at 9 a.m.